Our ancestors have practiced for centuries.
The names that move markets are on Bloomberg.
There's a complete change in the labor market. There's a complete change in the energy future that we are facing.
Under tightening would be a worse mistake than over tightening because we can course correct that.
The question is whether we need to increase the pressure or just keep pushing.
We've been getting good news. We just have to keep getting good news.
Nobody covers business like Bloomberg, your global business authority. Wall Street is waking up. Europe is already trading. And Manus Cranny and Danny Berger are making sure you have the news, data, and analysis you need to set your agenda. Micro, macro, and everything in between. Manus in New York and Danny in London follow the money around the globe. Take a daily deep dive into risk and help you make informed decisions for your trading day. Watch Bloomberg Brief, weekdays at 5 a.m. Eastern, only on Bloomberg. Context changes everything.
Live from the City of London for our audience worldwide, Bloomberg's The Fed Decides starts right now.
This is a special edition of Bloomberg Surveillance with Tom Keene, Jonathan Farrell, and Lisa Abramowitz. Bloomberg Surveillance, The Fed Decides.
Live on TV and radio for our audience worldwide. Good afternoon. Good afternoon. The countdown to the Fed decision starts right now. 27 minutes away, TK. Your equity market slightly positive and yields very close to cycle highs.
Here from the fog of London, it's Dickensian out there right now.
It's surveillance after hours, TK.
Yeah, we're going to see if
we'll
get some clarity from Jerome Powell. He's dealing with the fog of the American economy. A lot of cross currents here. I'm really interested to hear what Kathy Jones says about what yields tell us right now.
Looking forward to that conversation, TK, and so much more. As you know, Tom, it's a three-part act. Decision at about 28 minutes. Bunch of forecasts as well. Then on to the news conference about an hour away.
Well, the news conference is going to be different. And again, we're going to go to November. And what I saw from our guest this morning on surveillance was a real tendency to look to December. How does he frame in that press conference the forward view? The people in the room are less concerned with September and the dots. OK, but I'll give you that, John. I don't care about the dots. But the answer is they're going to go to November and they're going to go to December.
Andrew Holdenhorst, Citi, looking for that hike in November. Holdenhorst joining us a little bit later. This is how the stage is set. The price action looks a little something like this on the S&P 500. Equities are higher by 0.2% on the S&P. Yields are backing away from cycle highs. We're down about 4 basis points today to 431.67. I've gone through the three-part act, the decision, the forecast, the news conference. This is the two-part act of this show. Going into that decision, coming up, Morgan Stanley's Jim Keren, Deutsche Bank's Matt Lazzetti, Kathy Jones of Charles Schwab out the other side after 2 p.m. when that decision drops. Here's the lineup for you. Citi's Andrew Holdenhorst, Diane Swank of KPMG, Jim Bianco of Bianco Research, TK, Greg Peters of PGIM.
It's going to be interesting to see. Jim Bianco's maybe the most holistic there, pulling in the markets with the economy as well. And I go back to the Arch Bianco call, now hugely prescient about the longer, and that inflation comes down to where we are and goes flat or even with a little bit of an uptick. At the time, that was controversial.
And the ultimate contrarian call that maybe yields just have to go higher from here.
Well,
hearing that from Jim, we'll ask that question to Greg Peters of PGIM. Is this a buy in this bond market, TK, with a 10-year where it is, where the 2-year where it is currently as well?
It could break either way. And, you know, again, I think Powell will give us some direction. You know, he's going to be cautious. He's going to say, you know, this is what we see now. But again, I'm going to go to the gaming out of this into November, December. And John, quickly here, that's going to come off those dot plots, that middle range here from the announcement to the press conference. The analysis by Mike McKee of those dots is key.
The median dot for 23, for 24, the growth projections, we're expecting them to mark to market. Essentially, growth has been better.
Yeah.
Their forecast might have to come up. Inflation may be a little bit softer, but I'm with you. Where do they see rates beyond November into next year?
Not expert at the dots, but certainly expert at the bond outcome. Joining us now to get us started on the special show from London, is Jim Karen, to say he's Portfolio Solutions Group CIO at Morgan Stanley Investment Management's important. What you have to understand is after the physics of Bowdoin, the physics of Caltech, he knows the physics of Jerome Powell. I'm baffled, Jim. Is this meeting about today, or are you looking already to November and December?
Thanks, Tom. Look, I don't think this meeting is about today. As you put it, this meeting is about November and December and what he messages. Look, if we break it down this way, very, very simply, 2023 is about the Fed cycle coming to an end and them getting the job done to do enough to get inflation down towards target and keep it anchored there. 2024 is about holding rates higher for longer or potentially even cutting if economic conditions seem that it's likely that they need to do so. So the market will have no patience for rate hikes, further rate hikes in 2024, because if that's happening, then that means the Fed has missed something, inflation is accelerating, and that they're going to have to do something more drastic to bring inflation down. So I think if we look at this more broadly, we need to see in 2023 the Fed get the job done. So look, as far as the way that I see this meeting's all about positioning their potential policy act for November or even December.
I look at this, and the overlay to me is the good work of your Ellen Zentner, award-winning economics, and she's marked down GDP off revisions and some actual present numbers, and she's come down a fair amount, 0.5 percentage point of real GDP or even more. Are we on the edge of a stagflation era where we pull in from an Atlanta GDP guess of 6%, where all of a sudden GDP slows down and changes the Fed decision?
So I think that, third quarter GDP is likely to be still, relatively strong and robust. In the fourth quarter, there's likely to be some give back. But I think Ellen's onto something here, though. I think the markets are going to start to read through this, and they're going to say, like, look, third quarter GDP, some good technicals, things are strong, but this might be the last big thrash in the economy before it really starts to slow down. Now, if we think about this from the Fed's perspective, this is what rate hikes are supposed to do. You're supposed to see a slowdown in GDP growth, a slowdown in inflation, slowdown in wage growth, and everything, in even housing and everything else. So the goal here for the Fed is to get inflation down and keep it anchored and keep it down durably. Just getting a slowdown or potentially even a mild recession, yeah, that could help in terms of bringing inflation down, but the point is that they have to keep it anchored, because what could start to happen if they don't is by the middle of 2024, the year-over-year base effects might make inflation start to reaccelerate higher. So it's imperative for the Fed to get inflation under control between now and the middle of 2024.
Jim, Bruce Kasman, JP Morgan, on the program with us a little bit earlier on this morning. Bruce Kasman said that 2024 projections were aspirational. They were aspirations. And the idea that we can get inflation back to target without doing real damage to the labour market is aspirational, fanciful. Jim, do you agree?
I do agree. Now, target is 2%. Do I think we're going to get to 2% and stay there? No. Will the Fed take a victory lap if we get between 2 and 3% and it shows that it's stable and it's not accelerating above 3? Yes. I think that, what it would take for the Fed to actually get inflation at 2% and keep it there would probably be much higher policy rates and very likely a hard landing. I don't think that's what the Fed is aiming towards at this point. So I think we have to look at growth in 2024 as certainly slowing. We just can't see the acceleration of inflation, and I think therefore at that point the Fed would likely be happy with their policy actions and likely be able to keep rates high. Look, just because rates are high and they're not cutting, it doesn't mean that they're easing. The rates are still impacting the economy, and there's about a 9-month lag, and that is yet to be seen going forward. So I think that the work that they're doing in 2023 needs to have enough speed to keep momentum going to bring inflation down to last them through 2024. And that's why a November hike or a December hike is still likely on the table in their eyes.
Jim, I don't know what Chairman Powell says in the news conference about 50 minutes from now, but I can share with you, offer you a sneak peek at a Mike McKee performance in that press conference. Mike McKee told us this morning, this is the question he wants to ask. How much confidence do you have in anything that you are telling us today? Jim, when we hear the words of Chairman Powell, how much confidence does he have about the future?
I think he is making an educated guess like the rest of us. I really think that it's very, very uncertain right now. We're having a very unusual economic cycle at the moment. The unemployment rate has stayed very low. Wages stay relatively robust. So it's hard for us to think of having a deep downturn or a recession. Typically, at this point in the cycle, we would be really, really primed to have a deeper recession and everything else. The markets are just not functioning that way. So I think that the Fed's stance on this in terms of just being very, very cautious in terms of how they proceed is very, very important. So when the Fed says we're data dependent, what they're really saying is we're not sure. We're not 100% sure as to how things are going to develop and what our actions might be. I'm always going to go back to this one point, Jonathan, which is that the Fed needs to get inflation to a level that they're comfortable with. And to me, that's like 2.5%, maybe 3%, somewhere in there. But make sure it stays there, that it doesn't start to reaccelerate higher. So it gets anchored at a lower level, That's the absolute key. If it starts to reaccelerate, that's bad for everybody, and they just need to take the steps today to make sure that that doesn't happen in the future. And I think that's the balance of risks that they're playing with.
Hey, Jim, stay close, stick with us. This is great. Jim Karen there of Morgan Stanley. Jim's going to stick with us going through to that decision. Joining us in just a moment, Matt Lazzetti of Deutsche Bank, Kathy Jones of Schwab. Looking forward to those conversations. TK, the words of Jim Karen there, when he says, and he being Chairman Powell, says we're data dependent, to some extent he just means we don't know.
Well, they're back, and how do you go to the dual mandate? They're not only data dependent on what the job market does, which has been booming, everything considered, but also data dependent on a quieter GDP, and we really haven't seen a tepid U.S. GDP yet.
Looking forward to the Mike McKee performance in the news conference in about 50 minutes' time. Three-part act, you know it well. We're going to get a decision, some forecasts, and a news conference a little bit later this afternoon, all in the next hour. Live from London, this is Bloomberg.
CFOs are reshaping the C-suite. Bloomberg's Chief Future Officer shines a spotlight on these dynamic leaders.
Today's CFO has to be much, much more than a bookkeeper.
One of the most important things is looking around the corner.
We have to let go of the traditional legacy department store.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
You also have to be credible business leaders in order to really impact the business and steer the direction.
We are like biologists. We need to deeply understand the financial DNA of a company.
People just come with a playbook and say, okay, we're going to roll that. Don't do that. Think longer term.
It's an amazing time to be in this role. It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the Chief Future Officers of some of the world's most influential companies. A new episode every month, only on Bloomberg.
This is Bloomberg. The Fed will do what we all expect it to do.
So they'll pause.
Pause.
Hawkish pause.
A hawkish pause.
A pause, but an indication that they're prepared to do more.
They'll keep wide open the possibility of another hike.
Emphasize that November continues to be a live meeting.
One more rate hike has to remain on the table.
Chair Powell is going to say that they are remaining vigilant.
They'll make it very, very clear that they are still data dependent.
And they're going to push back against this notion that they'll be cutting anytime soon.
The big question mark is, are they going to do something in November?
What do they do November 1st, their next meeting?
I think that the Fed is done hiking rates.
We see inflation coming down.
They're going to raise rates in November.
The economy is still very strong.
It's a really tricky needle to thread in terms of doing just enough, but not too much.
In November, we'll see what happens.
Whether this is going to be a skip or a pause is to be seen.
Well, it took us at least 15 minutes to say it, but we're saying it. Hawkish pause is what is widely expected, a phrase overused over the last month or so in anticipation of this particular Federal Reserve decision. If you are just tuning in, welcome to the programme, live on TV and radio. This is a Bloomberg Surveillance special, counting you down to a Federal Reserve decision for the month of September. That decision is about 15 minutes away, and the price action is shaping up as follows in the equity market. On the S&P 500, almost totally unchanged. We're positive by about 0.1% on the S&P at the moment. On the Nasdaq, we're negative by 0.14. That's how the session is shaping up currently. Of course, that can all change with the decision in just a moment, alongside the forecast, together with a news conference from Chairman Powell, which starts in the next hour or so. Beyond equities in your bond market, it's amazing to see it all over again. Tom, we've talked about it, how we're slowly and then quickly internalising this high-for-longer message from this Federal Reserve, with a 2-year still north of 5%, yields in this morning and this afternoon, and the 10-year still in the 430s, and the 30-year still around 440.
In 4 basis points on the 2-year at 5.05. As you mentioned, John, you were going back and forth with someone here earlier today on a 5.09 2-year yield. I think a huge body of people watching this Fed Decide special haven't yet framed out a 5.09, or, you know, what money market funds do on the way up there, as Deborah Cunningham talked about.
It's amazing to see, Tom. Yeah. And with that front end elevated, we've seen significant dollar strength come through over the previous several weeks. The euro at the moment just about holding on to 107. TK 107.26 on euro dollar.
As we near here 2 p.m. in New York and Washington, we have great conversation for you to frame out this moment. Kathy Jones joins us, Chief Fixed Income Strategist Charles Schwab, Matt Lazzetti at Deutsche Bank, and we continue with Mr. Karen. Jim Karen joins us from Morgan Stanley as well. Kathy Jones, I want to talk to you about the real yield. To me, it's ending a real rate analysis. We really haven't done that since before 2007. Interpret how Jerome Powell and his team interpret a 1.96 10-year real yield. How do they handle that?
I think the way the Fed looks at this is as an evidence that they're tightening policy. So we haven't seen it play through in the credit market. You know, credit spreads have actually fallen. And so the financial conditions indices have been relatively buoyant. But real yields matter a lot when you're talking about business investment or consumer spending. Ultimately, that real yield's very important. So I think the Fed is looking at that and saying, okay, inflation expectations have been anchored, but we've had almost all of this lift is coming in real yield. I think they're looking at that as, yeah, we're getting some of the tightening through in our interest rate policy, and it's maybe not in the credit markets, but it's certainly there in the real economy.
So, Matt Lazzetti, let's build on what Kathy just said. Given all of that, are we sufficiently restrictive?
Yeah, I think the Fed thinks that we're close. You know, they are likely to show another rate hike this year. Our baseline is that they don't deliver on that, that ultimately we get enough evidence that the labor market and growth are slowing into the end of the year, that they don't hike in November, December. So we're at the peak at the moment. You know, I think you're beginning to see some evidence of it for the consumer. You're seeing delinquency rates rise. And at the time where you're seeing some of these headwinds hitting the consumer from higher gas prices, tightening of credit conditions, return of student loan debt, I think these things will help them achieve the sufficiently restrictive stance that they're searching for.
Matt, you're always bravest guy in the street. You got a little narrow paragraph at the bottom of your note. On 2026, you think we converge to a normal economy, something like 2026. What is that real GDP number that you and Jerome Powell have to consider far, far out in 2026?
Yeah, look, I think there's substantial uncertainty about what the Fed's going to do through the rest of this year. There's meaningful uncertainty about 2024. There's a ridiculous amount of uncertainty about 2026. I think that is all kind of a messaging perspective from the Fed. It is, is the economy converging back to what they think the long-run values are? On their view, it's 1.8% for real GDP. I think from our perspective, there's upside risk to that as you look further out. Productivity growth from a tight labor market, I think, could be materially higher than what the Fed is currently pricing in. Your own view is that potential growth is above 2%. But look, that's mostly a messaging thing from the Fed's perspective at the moment.
You're better at this, John, than I am. Do we get 2026 dots today?
I think the long dot is interesting. That's going to be the conversation around where they believe neutral is, Tom, where we will be going back to. What does that trip look like? I don't think Chairman Powell wants to have that conversation at the moment.
No, Matt Lazzetti does.
Jackson Hole. But Kathy, to some extent, Mr. Williams over at the New York Fed has engaged in that conversation. When you look at the projections, Kathy, that come out in 10 minutes, beyond the decision, most people expect it to be unchanged. For growth, for inflation, the dot plot, what are you expecting to change? How does this shape up compared to, say, what we saw in July?
Yeah, excuse me. Sorry. I think we'll see the growth numbers revised up a little bit to reflect the third quarter bounce. And then the inflation numbers revised down a little bit because, we're starting to see that core PCE pass through to the downside. So those would be the big changes I would expect, but they're incremental.
Matt Lazzetti, I know that you've got to run. We've got about 50 seconds left with you. Can we just finish there as well, Matt? What you'd expect to change in the forecast, the projections we get from the Federal Reserve in 9 minutes' time?
Yeah, I think we know it's going to growth upgraded substantially. We think it doubles this year. Core inflation comes down a bit. I think really the focus should be on 2024. It's on, do they still expect inflation to be 2.6%? Do they still think that requires some pain in the labor market with the unemployment rate rising? And really, what does that 2024 dot look like? We think that it comes up by 25 basis points, that the Fed needs an even higher real Fed funds rate to achieve their objectives. But I think if we step back, if that is the hawkish message from this meeting, we've gone through a year where the hawkish message was upgrading the terminal rate, upgrading growth and inflation. If the real hawkishness that comes out of this is some view on 2024, I think that's a hard thing to sell to the market as a terribly hawkish message.
Matt Lazzetti, thank you for joining us today. And what a great call from Dr. Lazzetti that we saw where he said, yes, recession, but out there somewhere. No one was more prescient about that than Matt Lazzetti. Jim Karen is with us with Morgan Stanley. Hey, Jim, I look at all that we're talking about here, and it comes back to the physics of going back to a normal rate environment. Nassim Taleb, the quant, said the gravity's return to the system. You're degreed in the gravity. Tell me the gravity, the physics that Jerome Powell has right now. Is it a 1994 physics?
I think we're getting close to it, right? So, these rates are high right now. They're not extraordinarily high, but they're high enough to put pressure and force down on the economy to continue with the physics analogy. So, yes, gravity is going to pull this down. Look, there's a lot of things. There are a lot of headwinds in 2024 from a policy perspective. Number one, the higher rate hikes are going to start to bite. Number two, the refinancing. People talk about maturity walls, that are coming up. It's going to be more expensive to do business. And number three, it's going to put pressure on valuations, right? So bond yields being higher, a Fed that's higher for longer, is going to continuously put pressure on just the broader markets, financial conditions, equity markets, I would even say. Just given the alternatives that investors have to invest in bonds with a higher, potentially more attractive yield as we move into 2024. Because, look, as Matt was saying, there is a recession that's out there somewhere. Whether it's a deep recession or it's a mild recession, I'm in the camp it's a mild recession, but it's a slowdown. And I think that there's going to be a bigger balance between, when we think about asset allocation, between fixed income and equity.
As Jerome Powell goes into this press conference in 6 minutes, Jim Karen, is he a single mandate Fed chairman? Is he on the edge of Christine Lagarde?
Yeah, I think his primary mandate is getting inflation where it needs to be. I think the jobs market is structurally very strong for various reasons. The big thing that everybody's talking about, what we're all concerned about the most, is can the Fed get inflation towards an area that they're comfortable with in terms of their target and keep it there. So yes, the Fed does have a dual mandate, as you pointed out. It's price stability and full employment, but I think the Fed is willing to risk it a little bit on the jobs front in order to get inflation down. So I hate to phrase it this way, but I think that a mild recession actually plays well in the Fed's calculus to get inflation down. So I think they're willing to push it and risk that in order to get inflation to target. So let's not call it a single mandate, but pretty darn close.
Do we call that a soft landing? Kathy, I'd love your view on that. We throw around these phrases. I don't know what they mean anymore. What is a soft landing to you, Kathy? What is it?
Well, I think it would be a slowdown in the economy and a reduction in inflation without a big rise in unemployment. And I agree with Jim. That's a tough thing to pull off. It's more likely we'll have some sort of a downturn in the economy if we really have a Fed that's determined to get back to that 2% target on inflation. So soft landing, seems like an aspiration, as you mentioned earlier. I think every Fed wants to accomplish it, but it's really hard to pull off.
Agreed. And I think a lot of people listening agree as well. Jim, one thing you've been fantastic at all year, I'm sure there's many, but I'll pick out one. You asked us to ask and really question what could go right this year. And when we think about risk, there is upside risk, not just downside risk. Jim, how are you thinking about that particular question now?
Yeah, look, I still think that there are upside risks. I mean, it's we're talking a lot about recession, but we also have to recognize that if it's a mild recession or if it's a soft landing of some sort, however we define that, earnings growth, when we think about bottoms up earnings, that's been rising. 2024 earnings around $248, $249 right now. Many people were forecasting that we would have sub $200 earnings, right? Multiples have held up reasonably well. I think what could go right is that the market looks through what could be potentially a mild recession and buys the dip quicker than what many people think. The number one question I get from a lot of clients is, I missed the rally, where can I get in? So there are a lot of people with dry powder that's looking to buy the dip.
Kathy, I want to give you the final word. What's the number one question you get from clients at the moment? Is it the same one?
The number one question I get from clients is, when do I extend duration? I've been sitting in cash forever and ever, and I want to extend duration because I want to lock in yields, but I'm afraid to move.
We hear that a lot too. Kathy, thank you. Kathy Jones, Jim Caron, your Federal Reserve decision about 3 minutes away. Said this a few times, three-part act. At the top of the hour, you'll get a decision from the Federal Reserve, a bunch of forecasts as well. Mike McKee's going to break that down for you. 30 minutes later, a news conference in Washington, D.C. with Chairman Powell. Plenty of questions, of course, for Chairman Powell. But TK, before we get there, you've got the meat of the statement and then straight to the forecast. I think for a lot of people, it's straight to the forecast.
The heart of the matter.
2023, how much movement are we expecting? Growth up, inflation down, maybe. Yeah. Show me the median dot. Do people start to nudge that extra hike away, maybe a little bit? Does that change the median? Yeah. And then out to 2024.
I think the dots are the most important thing this time. I usually don't say that, but within that is the background news. Is he going to address a strike in Detroit? I believe is Jamie Dimon of J.P. Morgan will speak in Detroit today. Maybe he's already done that. We're a bit out of the time zone here, but I think there's a set of data and a set of global events right now, including China, that he has to allude to in this press conference. That's not seen in the dots. The dots are a pure U.S. guess. There's more going on than the dots.
So Andrew Hollenhorst of Citi is going to join us in the next 30 minutes or so. Andrew put out a note, publishing with the team a little bit earlier, Citi Economics, and they made 3 points, TK. One is the strikes with UAW. Yeah. The second was oil, and the third was house prices. I would pick up on oil and throw in China. So I'm Oil and China were believed to be tailwinds at the start of the year. Energy was coming in, China was reopening. Are they headwinds now at the back end of 2023? Most people would assume they are.
What they are, and this goes to data dependency, there's something that's happened in the last 14 days. Maybe it's 20 days. I'm not keeping that count. But this surge that we've seen in oil, with Javier Blas looking at Saudi Light near $100 a barrel. I saw a 97 quote on Saudi Light spot, I think 48 hours ago. That's new, and that's new for the people at the Eccles building. They are data dependent, but it's just not economic mumbo jumbo. It's what's going on in the rest of the world, including China.
Neil Dutta of Renaissance Macro wants the last word going into the Fed decision.
He's one of our best guests.
Dutta writes in, this is wish casting from the Fed. They are wish casting a soft landing, but the reality of 2023 is that we have not landed at all. We're running at an above trend cruising speed. We'll get the forecast from the Federal Reserve in about 20 seconds time alongside that Fed decision. Going into it, the price action looks like this on the S&P 500, positive by 0.2%. On the NASDAQ, almost totally unchanged. To the bond market, yields on a 2-year shaping up as follows. Near, in and around 5% on a 2-year in America, 5.05%. Mike McKee has the decision.
This is the very definition of a unanimous hawkish pause. The Fed leaves rates today in the range of 5.25% to 5.5%, while saying growth is solid and inflation elevated. So, higher for longer. Policymakers leave another rate move on the table for this year and take 2 reductions off the table for the next 2 years. The statement once again discusses, quote, the extent of additional policy firming that may be appropriate. And the dot plot shows that 12 members of the Open Market Committee still believes they will raise rates by another 25 basis points this year. The high dot at 6.25% comes out of the dot plot with St. Louis Fed's Jim Bullard's retirement. For 2024, the committee now sees a median effective Fed funds rate of 5.1%, up 50 basis points from their June projection. And for 2025, 3.9%, up from 3.4% in June. The long-run neutral rate is unchanged at 2.5%, although the central tendency range moves up to 3.3% from 2.8%, and the dots show 7 members think that neutral is higher than 2.5%. All this because the Fed sees stronger growth, lower unemployment, and lower core inflation ahead. The economy should grow 2.1% this year, they say. That is up from 1% in their June forecast, more than doubling. They say next year growth will be 1.5%, up from 1.1%. Unemployment will finish this year at 3.8%, down from their June forecast of 4.1%, and in the next 2 years end at 4.1%, down from 4.5%. PCE headline inflation will be 3.3% this year, up 1/10, basically on energy concerns, but their core PCE forecast falls to 3.7% from 3.9%. Next year, it falls to 2.6%. And one final note, no change in QT, no change in the IOR or repo rates.
Mike, stay close. I'm just going to work through the price action. So off the back of this decision, we're negative by, let's call it 0.2% on the S&P 500. As you might expect, the NASDAQ underperforming. If you turn to the bond market, yields were lower almost across the curve at the front end as well. They're now higher by 3 basis points. Looking at, staring in the face of the potential of closing at new cycle highs on the front end. 5.1287 turns to 5.13 on a US 2-year. So yields up, new cycle highs at the front end of the curve. And the dollar off the back of it, a whole lot stronger. The euro against the dollar, 106.89 on the session, positive still by about 0.1%, but certainly off the back of that decision, a stronger US dollar. Mike McKee, I want to come to you on that median dot for 2024. Are you basically telling me the Fed took back half the cuts that were priced for 24 in their previous projection?
That's basically what I'm telling you, John. They were looking at 4.6%, and now they've gone up to 5.1%. Clearly, they think the economy is strong enough that they may need to do more. At least that's the message they want to send to the markets.
Mike McKee, I look at the growth forecast. You went through them quickly. Maybe they don't make the headlines. I think they should. Frame out again their growth vision, as Neil Dutta says, their wish casting for 2024.
Well, the biggest change is 2023. This year, obviously, the way things have been going, they need to mark up growth for this year. They call it solid. 2.1% is their final growth. But growth next year is 1.5%. That's up from 1.1%. That's a fairly strong change. So they do see perhaps the wish casting that Neil is talking about, the idea that growth can be stronger into next year, and it does certainly suggest the idea of a soft landing.
I look, Michael McKee, at where we are in this, and it gets to November and December. I know your first question to the chairman will be, tell me about November. Mike McKee, tell us about what this translates into for the next meeting.
Well, it's definitely going to put the markets on guard, depending on what kind of data we see, especially in the inflation numbers. The Fed's acknowledging that we're going to see a little bit higher headline, a little bit lower on the core. And if that's what we get, then the Fed could decide to raise rates. It's hard to know exactly because of the energy components that are coming into this, but that's what to watch for when we get the CPI and PCE numbers. The other, of course, joker in the pack is if the government does shut down and there is no data, the Fed will have to use its own kind of methods to figure out where it thinks inflation is.
Mike McKee, thank you, sir. We know you've got to run and get to that news conference. Mike McKee's going to sprint to that. It begins in about 25 minutes' time. Just to go through the forecasts again, that is a monster upward revision to GDP. But they're market to market at the Federal Reserve. So they go from 1% to 2.1 for 2023. Tom, the story for me is out in 2026. The story for me on unemployment, they've got it at 4% and PCE back down to 2%. All the way out there, several years away, and this is the aspirational, fanciful stuff that this is how it's going to happen. Unemployment for this year, by the way, 3.8% is the forecast now, and it only climbs to 4.1% next year. Bruce Kasman talked about this a little bit earlier this morning at JP Morgan. Tom, how high does unemployment need to go to get inflation lower? That's going to be a question we could explore in the next 25 minutes or so. But the Federal Reserve is telling you that they can get back to target 2% in several years' time, and unemployment's going to be in and around 4%.
I'm going to go with Duddy here and combine it into what Matt Lazzetti said. I got lucky in that I picked out of Matt Lazzetti's note his first look at 2026. I don't even know if there's a first look to first quarter 2024. The uncertainty here, off the pandemic, off the shift from a supply analysis to a demand analysis of the economy, and that's a pretty clumsy move. John, I looking out to 26 now, maybe they're forced to do that, but boy, that's a tough thing to do. Let's do this, and we're very lucky today to do this because we can fold in what you're all reading and feeling about the strike in America. Diane Swank is steeped, I should say, in Midwest economics, her tenure at Bank One, and of course her academics at Ann Arbor. Andrew Hollenhorst with us as well. Diane Swank, I guess the chairman has to mention the strike today. How do you fold strike analysis into the chemistry the Fed has?
It's really tough. I don't think it. First of all, the strike is very targeted. We'll see over this weekend how far the strike gets. I think many people are worried about how long the strike will last, and that is important. It both suppresses economic activity, of course, constrains inventories, but it's constraining inventories in a different way than the chip shortages did. So I'm not as worried about vehicle prices being the push on inflation that they were, that some people are, given that this is a more limited kind of production hit, and it actually gives market share to other producers out there. At the same time, demand has fallen quite dramatically for new vehicles because financing rates have gone so high. I think what's really important in what the Fed just did was the whole concept of higher for longer, much higher for longer, and potentially a higher neutral rate on the other side of this. This is what the theme was coming out of Jackson Hole Symposium, was how synchronous the idea of higher for longer mantra is across the developed economies. That even as we approach this peak in interest rates, that the central banks are emboldened because of the resilience that we've seen even in those economies that have suffered recessions, have not been as bad as they expected, that they are emboldened to hold rates higher for longer. And there is a concern on the other side of this that they're going to need a higher neutral rate. This is a different world than the world that we left in 2019.
Far different, far different. Andrew, at the start of this hiking cycle, we asked a pretty important question. Can we get inflation down to target without doing too much damage to the labour market? Overwhelmingly, people said we couldn't. We've made some progress without killing off the labour market. The Federal Reserve today, Andrew, is extrapolating that out. How hopeful, Andrew, is that forecast?
I think that's the big question that these forecasts raise. You have 2023 growth revised materially higher. You have that strong growth continuing into 2024 now in their forecast. So you have an economy that's running at or above potential. You have an unemployment rate that's historically low. And yet we're meant to believe that wages and prices will cool in this economy. This just contradicts basic macroeconomic theory. So this is a forecast that does not line up with traditional ways of forecasting the economy, with the relatively intuitive idea that when labor markets are very tight, that pushes up wages. And when labor costs are rising, that pushes up prices. So I think this is a difficult forecast to square with the reality of how economies behave. That's to be addressed at a later point. I think what the Fed did today makes sense in the sense that we're running strong growth, we're running inflation that's above target, so it makes sense to guide towards higher for longer. So they achieved the hawkish skip. If that was the intent, that's achieved. I think in terms of the forecast, there are some real questions that need to be answered.
The hopes and dreams of these forecasts, Dan, let's sit on it. I remember a word that you used maybe more than a year ago. You referred to the forecast from the Federal Reserve as fanciful. Aspirational was a word we heard again this morning, repeated through this afternoon. Dan, when you look at these forecasts further out, do you think it's the right approach to extrapolate out current dynamics, which essentially is the following? Inflation can come down, can come in further without doing real damage to the labour market?
I think it's a great idea, and I hope they're right. I do think it is still fanciful. One of the things that I think that the Fed is betting on is that we are seeing the high-frequency data as the labor markets have cooled. This has been one of the most dramatic, frenzied pace of a labor market and then cooling that we've ever seen, with unemployment still very low. And what they're counting on is the high-frequency data on job postings shows that wages are slowing even more rapidly as we go into fall. So they're betting on those things, helping them. At the same time, we haven't seen in decades as many strike actions as we're seeing right now. And that's where things like the current strike with the UAW, the strike that we're seeing in healthcare, the strikes that we're seeing ongoing with the actors and the writers union, those things will have an impact. And how much we see the cost of living adjustments baked into contracts going forward is going to be very important. Remember, with the pop in energy prices, we're going to see an increase. The September CPI is what sets the numbers for Social Security bump in January.
Right.
That's one of the reasons. It's going to be a higher bump now. That's one of the reasons we had stickier inflation at the start of this year. And so that could be a sticking point and be harder for the Federal Reserve.
Andrew Hollenhorst, you need a victory lap right now. We've got a 5.13% two-year yield. I've got a 10-year real yield any moment to pop through 2%, 1.99% right now. How does our economy, how does our business society, how does it adapt to a 2% real yield? Is that a signal of buoyancy and resilience, or is that a signal of trouble to come?
You know, we've seen the economy a lot more resilient to higher interest rates than I think many people expected at the beginning of this rate hike cycle. And part of that is that a lot of the debt that's out there is fixed rate debt that doesn't mature for many years. You think about 30-year fixed rate mortgages. Many of those are still at lower rates. You think about some of the corporate borrowing that's taking place, and that also hasn't all been refinanced yet. So as that debt is refinanced, you start to have people, individuals, and firms experiencing higher rates. That should slow the economy. You see credit that's tightening. So there is a sense that this is slowing the economy, but it has to be sustained. And I think that's the message in the dot plot.
For Bloomberg Radio Worldwide, bring up the chart again on television here that we just put up with the 2-year yield back to before the pandemic. And this is an arch call by Hollenhorst, and Swank was very good at this as well. Andrew Hollenhorst, we're back to yields that I remember and Diane Swank doesn't remember. The consensus belief out there is, OMG, we're all going to die with this yield structure. We're going to a 6% 2-year Hollenhorst yield. Are we all going to die?
Well, remember the 2005 to 2007 period. This was an extended period of time when the economy performed relatively well and we sustained higher yield levels. And it wasn't that long ago, but it just feels like a long time ago, and many people haven't experienced that yield environment. So I think this is kind of rediscovering that economies can continue to grow, continue to produce inflation at higher yield levels. Eventually, these levels may be restrictive enough, sufficiently restrictive in the words of the Fed, to cool the economy, but that's a process that can take time.
Diane, you're one of the best at this. Give Mike McKee a little bit more help. What's the question for Mike for this chairman in this news conference that starts in about 15 minutes' time?
I really want to know about how they're so optimistic about growth for next year, given some of the headwinds that we face going into next year, everything from higher oil prices to student loan repayments, and the additional tightening that they expect in the pipeline, not only in the banking sector, but more broadly. So, that 1.5% is really pretty stunning, with 0.5% higher on short-term interest rates. That's remarkable resilience with the cooling of inflation, and I'm just trying to square all that all comes together.
Yeah.
Oh, Diane, we all are. We're trying to figure this out. Diane Swank there and Andrew Hollenhorst, two of the very best on the Federal Reserve. That news conference starts in 15 minutes. If you're just joining us, welcome. Special coverage of the September Federal Reserve decision, live on TV and radio, a Bloomberg Surveillance special. Alongside Tom Keene, I'm Jonathan Ferro. The decision, unchanged, no change on rates of the Federal Reserve. The focus on the projections of this Fed, a monster upgrade to GDP for this year, in many ways marking to market. No news there. We understood that growth was better than expected through much of this year. They understand that now. The new projection is 2.1%. The old projection was just 1%. An upgrade to the GDP forecast as well for next year too, for 2024. That goes from 1.1% to 1.5%. Some of the projections elsewhere are pretty fascinating. 12 of the 19 officials on the FOMC still forecasting, plotting an extra hike this year in 2023. In 2024, the median dot, we priced out half the cuts they had projected in the previous set of forecasts. But ultimately, it's the soft landing hope and dream. The decision, Tom, today is to extrapolate out current conditions. The idea that we can get back to target, all the way back to 2%, without seeing unemployment climb much higher than 4%.
We had a banner up moments ago on television here, and I did the quick nominal GDP math, and this is basically out 24 months, out 36 months, out to when we turn into a pumpkin. John, it's simple. They're looking at 4% nominal GDP or lower. And there's a lot of people looking at the spirit of this economy saying that with this inflation that maybe strengthens the economy, and it's to bust Bramo's chops, it's a toxic brew.
It is a toxic brew. But for them right now, there's nothing toxic about those projections.
I can't get out to 25,
Max Kettner.
26.
We said Max Kettner, HSBC. He started talking, and we said that sounds like Goldilocks forever.
Yes.
Aren't those projections Goldilocks for the next 12 months?
I would.
The rest of the cycle?
I would say so. And what's interesting here, folks, we're coming to you from London, is, those of you on TV can tell the sunset is spectacular tonight. I went out on the sidewalk in the rain here, the lovely afternoon rain.
How did that work out for you?
In the fog of London, practicing for Bank of England tomorrow. And this jumble that we're seeing right now in America is the same exact theoretical jumble we're going to see tomorrow with the Bank of England. These people are making it up as they go.
Let's turn to the price action and see how much Chairman Powell has to say in the news conference that starts in about 13 minutes. Your equity market totally unchanged on the S&P, slightly negative on the NASDAQ, but this move in the bond market, Tom, let's sit on that. The 2-year cycle highs.
Yeah, that's a key thing.
Through 5.1%, just like that, up by 3 basis points on the session, Tom. Yield on the 10-year, not much price action there, 434. 30-year, let's call it 440 TK on the long bond.
Let's bring it in right now. This is very important. PGIM's Greg Peters with us on yield, and Jim Bianco with us with Bianco Research. Jim, let me go to you right away. I just think this is so important. There's a sense of longer. I see a nominal GDP call out 24 months, which is not longer. It's that finally rates come in. Do you buy it?
Well, I buy the idea that you want to be looking at GDP, nominal GDP, as being a benchmark for long-term interest rates, but I'm not buying this idea that nominal GDP is going to fall to the levels that they think. If I was to describe, this confusion that we seem to have about this Fed policy, they're almost arguing that nothing of significance happened in 2020 and that we're going to return back to normalization, the word we like to use that's replaced transitory, and go back to something between 2010 and 2019 where we can have 2.5% real growth, 1% to 2% inflation, 4% nominal growth, and that would bring everything down and you'd have Goldilocks forever. But I'm not so sure that that's the case. I think that the economy has changed since the shutdown restart in 2020, and the Federal Reserve is still struggling to come to grips with that, and they're still thinking we're still in the last cycle.
Greg, you've got to work with real money here. The decision to extend duration, to find the belly of the curve, all the other professional stuff you do at PGIM. Does the language and the nuance of the forecast and the dots, does that change your conviction in what you're doing with your portfolios?
Well, I would say that we're finally getting what we've been thinking for quite some time, and that is higher for longer, right? The markets have been raging against this notion that rates will remain high. All the forward curves are pointing down, the dot plot pointing down. So I think this really throws cold water on that. And so for us at PGIM, we really think it's a higher for longer. We never felt the need to jump into duration. Maybe it's closer to that now, but more in the back end of the curve. So, look, I think the Fed delivered exactly what they wanted to, provide a hawkish sap that allows them to speak more dovishly and perhaps not move rates higher here.
Greg, it's not just the high for longer message that jumps off the page of the SCP. It's the growth inflation mix looking out a year, 2 years, that they believe you can get back to target 2%, and unemployment's going to drift higher, maybe to 4%, and basically stop there. Greg, that has big implications for how you invest elsewhere, beyond rates, bonds, and to credit. Is that your outlook, that basically we can achieve back to target inflation, barely shaking up the labor market in any way, shape, or form?
Well, it is very aspirational. There's no doubt about it. That is a Goldilocks type of outlook. If you have an environment where, rates remain higher, but growth is quite robust and inflation's coming down, I think that is a fantastic investing backdrop. I do think we're pretty close to it. The challenge, of course, on the table is all these different uncertainties and cross currents, and that has not gone away by any stretch of the imagination. So, we need to take these forecasts with a grain of salt. There's no different than our own forecasts, right? They're rife with uncertainties, but I do think there's a distinct possibility here, at least directionally, and I feel pretty good about the outlook.
Jim Bianco, do you feel pretty good about the outlook?
If we're talking about the outlook about the Fed, I have my issues with it like everybody else, but to feed on something that Greg just said, let's be real. We all have forecasts, and most likely they're all wrong. But that's okay, because we're not being expected to predict the future. The key is whether or not we can adjust. We can see that, okay, the data's coming in not as we expected, and we need to adjust these forecasts. Now, the Federal Reserve in the last couple of years has not had a good track record on that. We can all remember transitory. And what I'm afraid of with this Goldilocks forecast is when the situation comes in that it's not panning out, they're going to dig in their heels and continue to say it will, and they might wind up making another transitory type of mistake in 2024. I'd like to see Chairman Powell, show some flexibility with these forecasts to say, look, this is what we think now. But if the circumstances and data comes in soon, that's out the window and we're going to adjust. And that, like I said, that is okay. That is what you should do with a forecast, not just keep at it because you're afraid of some embarrassment of having to change it.
Jim Bianco, the laureate Paul Krugman, with a wonderful essay on disinflation, and he really emphasized what the Fed doesn't look at, which is plain vanilla inflation. Are they just in the fog of London, in the fog of Washington, the fog of across America, are they missing a disinflationary tendency in place?
I don't necessarily think they are missing a disinflationary tendency. I happen to be in the camp that inflation on a year-over-year basis, I'm talking about headline CPI, has bottomed for the year. It's going to drift towards 4%, not much higher than that.
Wow.
Energy prices are going to be a big factor in that drift higher, and that will be enough maybe to give us that one more rate hike that they're looking for, and to at least justify going from 4 to 2 cuts next year. And I think that if that continues, that the December update of this plot will probably take those 2 cuts away as well. So I'm in that inflation is sticky camp, and that the Fed is going to have to come to the realization that they're not going to get close to 3%. So the disinflation that they're hoping for, that inflation comes down, the unemployment rate could stay at 4%. It's been described here as fanciful, and I would also be in that camp too, that it is fanciful, and we'll have to see whether or not that type of situation unfolds.
John, moments ago, rounded up the 10-year real yield to 2%. This speaks to Dominic Constant Mazzuo's idea of we are restrictive.
Forgive me for thinking out loud, gents. There's a very, very simplistic approach to markets. You get economic information, data. You think about what it means for the Fed, and you trade accordingly. Now, Greg, I wonder if that's just changed off the back of these forecasts from the Federal Reserve. And let me go one step further and explain why. The first Friday of the month, we'll get a payrolls report. And if that payrolls report is hot, typically we'd sit there and say, well, labour market pressure, higher inflation, Fed has to do more work. But, Greg, hasn't the Fed just told us, haven't they just de-emphasised the importance of the labour market to the inflation conversation?
Jonathan, I think that's putting way too much emphasis on the SEP and the forecasts. I mean, at the end of the day, we're in this data-driven world. The Fed is trying to balance that out. And I think the markets, given the fact that we're in this data-driven world and we're not getting what we're wanting in terms of clarity out of the Fed, we're relying a little too much on this data release. So I don't think anything changes. I think if the data change, I think the Fed policy changes. And, you know, it's also important to remember 2 things. One is that, you know, they don't have inflation going down to, 2% until 2026, which is, you know, quite some time from now. And then 2, we just had a massive revision of GDP in this year. So, you know, let's use that as kind of a reminder that forecast error is really quite high here.
Jim, what are your thoughts on the same question?
Yeah, if I could give you a cynical thought, that is that let's see if we even get a payroll report on October 6th, because if we have a government shutdown, the BLS is closed, and Mike McKee's sitting in front of an empty building on that morning. So leaving that aside, I do think, though, that if you're talking about the payroll report, the consistency about it has been, it's been much stronger than we've been looking at for the last 14 to 18 months or so. All but something like 2 or 3 of the reports have been above consensus. And that seems to be the trend that I would think would stay in place. And if we see those kind of numbers come in, it's going to push everybody firmly into that, away from that Goldilocks and into that higher for longer camp as well.
We got to make some money to get home here, John Farrow. Ian Lingen, the screaming buy of the 10-year yield, just says this is a Fed doubling down on soft landing. Mr. Lingen, of course, at BMO Capital. Greg Peters, if they're doubling down on soft landing, for you at PGIM, is the 10-year yield a screaming buy?
No, I don't quite understand that logic, to be honest with you. I mean, what that would presuppose is that you'd have a healthy dose of cuts in response to that soft landing. So, no, I think yields are relatively range-bound here. I don't really see a big move either way. Yeah, it does look a little oversold. There's some technical dynamics, but ultimately on a medium-term basis, it looks pretty fair value to us. So I don't think the bond market, investing in the bond market is not about capital appreciation. That is a pre-pandemic trade. It is about roll and carry. And so, no, I don't expect it as a screaming buy.
With that in mind, Greg, if there's a pool of money, people sitting at home right now, they're sitting on the front end, they've been told by a couple of people that they should worry about reinvestment risk in the next 6 months and allocate accordingly further down the curve. Are you saying relax, patience, you're fine where you are?
Yeah, so I've been saying that the whole time. No one wants to listen to it, right? I think there's been this tendency to jump back into the pool because these higher rates are going to evaporate. What the Fed has told you today, what the markets are finally starting to respond to, is that no, these rates are actually around here for a while. So so I don't think there's any reason to rush. And so we like duration, but we wouldn't go hell's bells. Sorry.
And then let's fold this into Jim Bianco. I mean, John, it's just simple. Bianco was way out front with this idea of defining what longer looks like with a 10-year yield, and he's in the camp with Greg Peters.
Hey, Jim, this was great. Jim Bianco, together with Craig Peters. Thank you, guys. Going into this Federal Reserve news conference with Chairman Powell in about 90 seconds' time. I can tell you the 2-year, the high of the session, 514.80. We've backed away since then, Tom. We're up by 2 basis points to about 511 at the front end of the curve.
For those keeping score, the third week of August 2007 is when the follies began. And there is a headline in the Bloomberg now of a 2-year yield back to 2006. Lapels were wider in 2006. John, I can honestly say, I guess I would, say historically, someday you're going to revisit 2006. Did I think we'd see it off this pandemic now? Never.
At the front end of the bond curve?
No, this is a big deal. And again, I'm going to go, folks, from the nominal yield that we're all living. What does this do to mortgages? And I'm going to go to the real yield analysis, printing 1.99 up to 2% right now.
We've spent 30 minutes or so, Tom, talking about these forecasts from the Federal Reserve. Any moment from now, Chairman Powell's going to walk into the room, stand behind that podium and deliver his statement and take some questions. On those forecasts, let's reflect on the Mike McKee question of the day. How much confidence do you have in anything that you were telling us today? Well, and Greg Peters said it. We're putting too much emphasis, Tom, on those forecasts from this Federal Reserve.
This is the Latin mumbo-jumbo of ex ante and ex post, and there's never been this much ex post, this much data dependent. I think we're going to hear that across 3 central bank meetings with a week here in London. These people are living ex post because of a pandemic, because of a massive fiscal stimulus in the United States, not in every jurisdiction, a war in Ukraine, the endless litany that we have. But the heart of the matter is we're ex post.
The Chairman Powell walks into the room at the Federal Reserve on the September decision.
My colleagues and I remain squarely focused on our dual mandate to promote maximum employment and stable prices for the American people. We understand the hardship that high inflation is causing, and we remain strongly committed to bringing inflation back down to our 2% goal. Price stability is the responsibility of the Federal Reserve. Without price stability, the economy does not work for anyone. In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all. Since early last year, the FOMC has significantly tightened the stance of monetary policy. We've raised our policy interest rate by 5.25 percentage points and have continued to reduce our securities holdings at a brisk pace. We've covered a lot of ground, and the full effects of our tightening have yet to be felt. Today, we decided to leave our policy interest rate unchanged and to continue to reduce our securities holdings. Looking ahead, we are in a position to proceed carefully in determining the extent of additional policy firming that may be appropriate. Our decisions will be based on our ongoing assessments of the incoming data and the evolving outlook and risks. I will have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that economic activity has been expanding at a solid pace. And so far this year, growth in real GDP has come in above expectations. Recent readings on consumer spending have been particularly robust. Activity in the housing sector has picked up somewhat, though it remains well below levels of a year ago, largely reflecting higher mortgage rates. Higher interest rates also appear to be weighing on business fixed investment. In our Summary of Economic Projections, or SEP, committee participants revised up their assessments of real GDP growth, with the median for this year now at 2.1%. Participants expect growth to cool, with the median projection falling to 1.5% next year. The labor market remains tight, but supply and demand conditions continue to come into better balance. Over the past 3 months, payroll job gains averaged 150,000 jobs per month, a strong pace that is nevertheless well below that seen earlier in the year. The unemployment rate ticked up in August, but remains low at 3.8%. The labor force participation rate has moved up since late last year, particularly for individuals aged 25 to 54 years. Nominal wage growth has shown some signs of easing, and job vacancies have declined so far this year. Although the jobs to workers gap has narrowed, labor demand still exceeds the supply of available workers. FOMC participants expect the rebalancing in the labor market to continue, easing upward pressures on inflation. The median unemployment rate projection in the SEP rises from 3.8% at the end of this year to 4.1% over the next 2 years. Inflation remains well above our longer run goal of 2%. Based on the Consumer Price Index, or CPI, and other data, we estimate that total PCE prices rose 3.4% over the 12 months ending in August, and that, excluding the volatile food and energy categories, core PCE prices rose 3.9%. Inflation has moderated somewhat since the middle of last year, and longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. Nevertheless, the process of getting inflation sustainably down to 2% has a long way to go. The median projection in the SEP for total PCE inflation is 3.3% this year, falls to 2.5% next year, and reaches 2% in 2026. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks that high inflation poses to both sides of our mandate, and we are strongly committed to returning inflation to our 2% objective. As I noted earlier, since early last year, we have raised our policy rate by 5.25 percentage points. We see the current stance of monetary policy as restrictive, putting downward pressure on economic activity, hiring, and inflation. In addition, the economy is facing headwinds from tighter credit conditions for households and businesses. In light of how far we have come in tightening policy, the committee decided at today's meeting to maintain the target range for the federal funds rate at 5.25% to 5.5%, and to continue the process of significantly reducing our securities holdings. We are committed to achieving and sustaining a stance of monetary policy that is sufficiently restrictive to bring inflation down to our 2% goal over time. In our SEP, FOMC participants wrote down their individual assessments of an appropriate path for the federal funds rate based on what each participant judges to be the most likely scenario going forward. If the economy evolves as projected, the median participant projects that the appropriate level of the federal funds rate will be 5.6% at the end of this year, 5.1% at the end of 2024, and 3.9% at the end of 2025. Compared with our June summary of economic projections, the median projection is unrevised for the end of this year, but has moved up by 0.5 percentage point at the end of the next 2 years. These projections, of course, are not a committee's decision or plan. If the economy does not evolve as projected, the path of policy will adjust as appropriate to foster our maximum employment and price stability goals. We will continue to make our decisions meeting by meeting based on the totality of the incoming data and their implications for the outlook for economic activity and inflation, as well as the balance of risks. Given how far we have come, we are in a position to proceed carefully as we assess the incoming data and the evolving outlook and risks. Real interest rates now are well above mainstream estimates of the neutral policy rate, but we are mindful of the inherent uncertainties in precisely gauging the stance of policy. We're prepared to raise rates further if appropriate, and we intend to hold policy at a restrictive level until we're confident that inflation is moving down sustainably toward our objective. In determining the extent of additional policy firming that may be appropriate to return inflation to 2% over time, The committee will take into account the cumulative tightening of monetary policy, the lags with which monetary policy affects economic activity and inflation, and economic and financial developments. We remain committed to bringing inflation back down to our 2% goal and to keeping longer-term inflation expectations well anchored. Reducing inflation is likely to require a period of below-trend growth and some softening of labor market conditions. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
Thank you. Colby Smith with the Financial Times. What makes the committee inclined to think that the Fed funds rate at this level is not yet sufficiently restrictive, especially when officials are forecasting a slightly more benign inflation outlook for this year? There's noted uncertainty about policy lags. Headwinds have emerged from the looming government shutdown, the end of federal child care funding, resumption of student debt payments, things of that nature.
So I guess I would characterize the situation a little bit differently. So we decided to maintain the target range for the federal funds rate where it is at 5.25% to 5.5%, while continuing to reduce our securities holdings. And we say we're committed to achieving and sustaining a stance of monetary policy that's sufficiently restrictive to bring down inflation to 2% over time. We said that. But the fact that we decided to maintain the policy rate at this meeting doesn't mean that we've decided that we have or have not at this time reached that stance of monetary policy that we're seeking. If you looked at the SEP, as you obviously will have done, you'll see that a majority of participants believe that it is more likely than not that it will be appropriate for us to raise rates one more time in the 2 remaining meetings this year. Others believe that we have already reached that. So it's something where we're not making a decision by deciding to about that question by deciding to just maintain the rate and await further data.
So right now, it's still an open question about sufficiently restrictive. You're not saying today that we've reached this level.
We're not saying, no. Clearly, what we decided to do is maintain the policy rate and await further data. We want to see convincing evidence, really, that we have reached the appropriate level, and we're seeing progress, and we welcome that. But we need to see more progress before we'll be willing to reach that conclusion.
And just on the 2024 projections, what's behind that shallower path for interest rate cuts and the need for real rates to be 50 basis points higher?
Right. So I would say it this way. First of all, real interest rates are positive now. They're meaningfully positive. And that's a good thing. We need policy to be restrictive so that we can get inflation down to target, okay? And we're going to need that to remain to be the case for some time. So I think, remember that of course, the SEP is not a plan that is negotiated or discussed really as a plan. It's accumulation, really, and what you see are the medians. It's accumulation of individual forecasts from 19 people, and then what you're seeing are the medians. So I wouldn't want to, bestow upon it the idea that it's really a plan. But what it reflects, though, is that economic activity has been stronger than we expected, stronger than I think everyone expected. And so what you're seeing is this is what people believe as of now will be appropriate to achieve what we're looking to achieve, which is progress toward our inflation goal, as you see in the SEP.
Thanks. Let's go to Rachel.
Hi, Chair Powell. Rachel Siegel from The Washington Post. Thanks for taking our questions. How would you characterize the debate around another hike or holding steady? Is it discussion around lag times, fear of too much slowing, too little slowing? Could you walk us through what this disagreement was about at the meeting?
Yeah, so the proposal at the meeting was to maintain our current policy stance. And I think there was obviously unanimous support for that. But this, of course, is an SEP meeting, and so people write down what they think. And you have some, you saw, I think 7 wrote down no hike at this meeting, or between now and the end of the year, and I think 12 wrote down another single hike in one of the next 2 meetings that we have between the end of the year. So it wasn't like we were arguing over that. People just stating their positions. And really what people are saying is, let's see how the data come in. You know, we want to see, you know what we want to see. We want to see that these good inflation readings that we've been seeing for the last 3 months, we want to see that it's more than just 3 months, right? We want to see, you know, the labor market report that we received, the last one that we received, was a good example of what we do want to see. It was a combination of across a broad range of indicators, continuing rebalancing of the labor market. So those are the 2 things. Those are our 2 mandate variables, and that's the progress that we want to see. But I think people, they want to be convinced. You know, they want to be careful not to jump to a conclusion really one way or the other, but just be convinced that the data, support that conclusion. And that's why, given how far we've come and how quickly we've come, we're actually in a position to be able to proceed carefully as we assess the incoming data and the evolving outlooks and risks and make these decisions meeting by meeting.
I see. And in your view, I know nothing has been decided yet, but what would one more hike at the end of the year do to the economy or to inflation? And on the other side, what would no hike do, if you could sort of game that out for us?
So, you know, you can make the argument that one hike one way or the other won't matter, but for us, we're trying, obviously as a group, it's a pretty tight cluster of where we think that policy stance might be, but we're always going to be learning from data. You know, we've learned all through the course of the last year that actually we needed to go further than we had thought. If you go back a year and what we wrote down, it's actually gotten higher and higher. So we don't really know and that's why, again, we're in a position to proceed carefully at this point. A year ago, we proceeded pretty quickly to get rates up. Now we're fairly close, we think, to where we need to get. It's just a question of reaching the right stance. I wouldn't attribute huge importance to one hike in macroeconomic terms. Nonetheless, you know, we need to get to a place where we're confident that we have a stance that will bring inflation down to 2% over time. That's what we need to get to, and we've been moving toward it. As we've gotten closer to it, we've slowed the pace at which we've moved. I think that was appropriate, and now that we're getting closer, we have the ability to proceed carefully.
Thanks. Let's go to Steve.
Steve Leishman, CNBC. Mr. Chairman, I want to return to Colby's question here. What is it saying about the committee's view of the inflation dynamic in the economy that you achieve the same forecast inflation rate for next year, but need another 0.5 point of the funds rate on it? Does it tell us that the committee believes inflation to be more persistent, requires more medicine effectively? And I guess a related question is, if you're going to project a funds rate above the longer run rate for 4 years in a row, at what point do we start to think, hey, maybe the longer rate or the neutral rate is actually higher? Thank you.
So I guess I would point more to, rather than pointing to a sense of inflation having become more persistent, I wouldn't think that's not, we've seen inflation be more persistent over the course of the past year, but I wouldn't say that's something that's appeared in the recent data. It's more about stronger economic activity, I would say. So if I had to attribute one thing, again, we're picking medians here and trying to attribute one explanation, but I think broadly, stronger economic activity means rates, we have to do more with rates, and that's what that meaning is telling you. In terms of what the neutral rate can be, you know, we know it by its works. We only know it by its works, really. We can't. You know, the models and that we use. Ultimately, you only know when you get there, and by the way the economy reacts. And again, that's another reason why we're moving carefully now, because, you know, there are lags here. So it may of course be that the neutral rate has risen. You do see people. You don't see the median moving, but you do see people raising their estimates of the neutral rate, and it's certainly plausible that the neutral rate is higher than the longer run rate. Remember, what we write down in the SEP is the longer run rate, It is certainly possible that that the neutral rate at this moment is higher than that, and that that's part of the explanation for why the economy has been more resilient than expected.
Let's go to Howard.
Howard Schneider with Reuters. Thank you. So you've said several times that the economy needed a period of below-trend growth to get inflation consistently back to 2%. You kind of get that in 2024 a little bit. 1.5% is just a touch below what's the estimate of potential. So the fact that you're getting so much done at so much less cost, does that represent a change in how you think inflation works, a change in how you think the economy works, a change in the mix of supply healing versus demand destruction that's necessary to achieve this?
Yes, of course, it is a good thing that we've seen now meaningful rebalancing in the labor market without an increase in unemployment, and that's because we're seeing that rebalancing in other places, in, for example, job openings, and in the jobs worker gap. You're also seeing supply side things, so that's happening. I would say, though, I still think, and I think broadly people still think that there'll have to be some softening in the labor market. That can come through more supply, as we've seen as well. Also, remember, the natural rate we think is coming down, which is a supply side thing, so that the gap between any given unemployment rate that's lower than that and the natural rate comes down. That's a way for supply. That's a way for the labor market to achieve a better balance. So all of those things are happening. You're right. In the median forecast, we don't see a big increase in unemployment. We do see an increase, and but that really is just playing forward the trends that we've been seeing. That is not guaranteed. There may come a time when unemployment goes up more than that, but that's really what we've been seeing, is progress without higher unemployment for now.
So just to boil that down for a second, we've gone from a very narrow path to a soft landing to something different. Would you call the soft landing now a baseline expectation?
No. I would not do that. I would just say, what would I say about that? I've always thought that the soft landing was a plausible outcome, that there was a path, really, to a soft landing. I've thought that, and I've said that since we lifted off. It's also possible that the path is narrowed and it's widened, apparently. Ultimately, this may be decided by factors that are outside our control at the end of the day. But I do think it's possible, and I also think. This is why we're in a position to move carefully again, that we will restore price stability. We know that we have to do that, and we know the public depends on us doing that, and we know that we have to do it so that we can achieve the kind of labor market that we all want to achieve, which is an extended period, sustained period of strong labor market conditions that benefit all. We know that. The fact that we've come this far lets us really proceed carefully, as I keep saying. So I think, that's the end we're trying to achieve. I wouldn't want to handicap the likelihood of it, though. It's not up to me to do that.
Nick.
Nick Timmeros of the Wall Street Journal. Chair Powell, both you and Vice Chair Williams have indicated that sufficiently restrictive will be judged on a real rather than nominal basis, implying some scope for nominal rate cuts next year, provided further compelling evidence that price pressures will continue to subside. Is the FOMC focused on targeting a real level of policy restriction? And can you explain what would constitute enough evidence that will allow the FOMC to normalize the nominal stance of policy while keeping real policy settings sufficiently restrictive?
I mean, yes, we understand that it's a real rate that will matter and that it needs to be sufficiently restrictive. And again, I would say you know sufficiently restrictive only when you see it. It's not something you can arrive at with confidence in a model or in various estimates. And so what are we seeing? We're seeing, through a combination of the unwinding of the pandemic-related demand and supply distortions and monetary policies work in suppressing demand or alleviating very high demand. The combination of those two things is actually working. You're seeing, inflation coming down. It's principally now in goods, also in housing services. You begin to see effects of it in non-housing services as well. So we think that is working. And I think as we've said, we want to reach that. We want to reach something that we're confident it gets us to that level. And I think confidence comes from seeing, enough data that you feel like, yes, okay, this feels like we can for now decide that this is the right level and just agree to stay here. We're not permanently deciding not to go higher, but we would, let's say, if we get to that level. And then the question is, how long do you stay at that level? And that's a whole other set of questions. For now, the question is trying to find that level where we think we can stay there. And we haven't gotten to a point of confidence about that yet. That's the stage we're at, though.
But it looks like because there was an across-the-board drop in the core PCE inflation projection for this year, and even then it seems possible the core PCE inflation could come in even lower than the median at 3.7%. Would you see a case to raise rates still if it turned out that you were going to achieve the same real rate this year because the decline in inflation proceeds somewhat better than you currently anticipate?
The decision that we make at each meeting, and certainly at the last two meetings this year, it's going to depend on the totality of all the data. So the inflation data, the labor market data, the growth data, the balance of risks and the other events that are happening out there. We take all of that into account. So I can't really answer a hypothetical about one piece of that. It'll be trying to reach a judgment over whether we should move forward with another rate hike overall, and whether that would increase our confidence that yes, this is an appropriate move, and it will help us be more confident that we've gotten to the level that we need to get to.
Gina.
Thanks, Chair Powell. Following up on Nick's question, actually, John Williams, the New York Fed president, obviously, has said things to the effect of next year, as we see inflation, kind of, again, to Nick's point, as we see inflation coming down, we're going to need to reduce interest rates to make sure that we're not squeezing the economy harder and harder over time. And I wonder if that's basically the logic that you apply. Is that how you think about it? And then I also wonder, in the last press conference, you said something to the effect of, it's a full year out, those discussions, and people interpreted that to mean that you didn't see a possibility of a rate cut in the first half of next year. And I wonder if that was what you meant by that, or whether, how you're thinking about that timing.
No, when I answer these questions about hypotheticals about cutting, I'm never intending to send a signal about timing. I'm just answering them as the question is expressed. So please, I wouldn't want to be taken that way. Sorry, the first question was that how? Yeah. So we're as we go into next year, that's the question we'll be asking is taking into account lags and everything else we know about the economy and everything we know about monetary policy. The time will come at some point, and I'm not saying when, that it's appropriate to cut. Part of that may be that real rates are rising because inflation is coming down. Part of it just may be that it'll be all the factors that we see in the economy. And, that time will certainly come at some point. And what you see is us writing down, a year ahead estimates of what that might be. And, there's so much uncertainty around that. When we, in the moment, we'll do what we think makes sense. No one will look back at this and say, hey, we made a plan. It's not like that at all. These are estimates made a year in advance that are highly uncertain, and that's how it is.
Neil.
Thanks so much, Chair Powell. Neil Irwin with Axios. I wonder, how do you think about the question of whether the strong GDP growth we've been seeing is driven by excess demand versus supply-side factors, productivity, labor force growth? And relatedly, if GDP keeps coming in hot, even in the absence of inflation resurgence, would that on its own be a reason to consider more tightening?
So on your first question, we're looking at GDP very, very carefully to try to understand really what's the direction of it, what's driving it, and it's a lot of consumer spending. The consumer's been very robust in spending. So that is that's how we're looking at it. Sorry, your second question was?
There's GDP stays hot, but without inflation.
So I think the question will be, GDP is not a mandate, right? Maximum employment and price stability are the mandates. The question will be, is the heat that we see in GDP, is it really a threat to our ability to get back to 2% inflation? That's going to be the question. It's not a question about GDP on its own. It's you're expecting to see this improvement, continued rebalancing in the labor market and inflation moving back down to 2% in a sustainable way. We have to have confidence in that, and we'd be looking at GDP just to the extent that it threatens one or both of those.
Victoria.
Hi, Victoria Guida with Politico. There are multiple external factors that are playing out right now. We see rising oil prices. We see auto workers striking. There's the looming, very real possibility of a government shutdown. And I was just wondering, for each of those things, could you talk about how you're thinking about how that might affect the course for the Fed and the economy?
So there is a long list, and you hit some of them. But it's the strike, it's the government shutdown, resumption of student loan payments, higher long-term rates, oil price shock. There are a lot of things that you can look at. So what we try to do is assess all of them and handicap all of them. And ultimately, though, there's so much uncertainty around these things. I mean, to start with the strike, first of all, we absolutely don't comment on the strike, as we have no view on the strike one way or the other, but we do have to make an assessment of its economic effects to do our jobs. So, the thing about it is so uncertain. It will depend. The economic effects, it could affect, we've looked back at history, it could affect economic output, hiring, and inflation. But that's really going to depend on how broad it is and how long it's sustained for. And then it also depends on how quickly production can make up for lost production. So none of those things are known right now. It's very, very hard to know. So you just have to leave that uncertain. And we'll be learning, I think, over the course of the next intermeeting period, much more about that. And the same is true for the others. I don't know if you mentioned shutdown. I think of all of these as being on the list. We don't comment on that. It hasn't traditionally had much of a macroeconomic effect. Energy prices being higher, that is a significant thing. Energy prices being up can affect spending. It can affect over time. A sustained period of higher energy prices can affect consumer expectations about inflation. We tend to look through short-term volatility and look at core inflation. But so the question is, how long are higher prices sustained? We have to take those macroeconomic effects into account as well. Those are some of them. I'm not sure if I hit them all, but ultimately, you're coming into this with an economy that appears to have significant momentum, and that's what we start with. But we do have this collection of risks that you mentioned.
Craig Torres from Bloomberg News. I was a little surprised, Chair Powell, to hear you say that a soft landing is not a primary objective. This economy is seeing added supply in a way that could create long-term inflation stability. We have prime-age labor force participation moving up, where people can add skills. Workers want to work. We have a boom in manufacturing construction. We've had a decent spate of home building. And since inflation's coming down with strong GDP growth, we may have higher productivity. All are good for the Fed's longer run target of low inflation. And if we lose that in a recession, aren't we opting for the awful hysteresis that we had in 2010? So are you taking this into account as you pursue policy? Thank you.
To begin, a soft landing is a primary objective, and I did not say otherwise.
Okay. All right.
I mean, that's what we've been trying to achieve for all this time. The real point, though, is the worst thing we can do is to fail to restore price stability, because the record is clear on that. If you don't restore price stability, inflation comes back, and you go through, you can have a long period where the economy is just very uncertain, and it'll affect growth, it'll affect all kinds of things. It can be a miserable period to have inflation constantly coming back and the Fed coming in and having to tighten again and again. So the best thing we can do for everyone, we believe, is to restore price stability. I think now, today, we actually we have the ability to be careful at this point and move carefully, and that's what we're planning to do. So we fully appreciate the benefits of being able to continue what we see already, which is rebalancing in the labor market and inflation coming down without seeing an important, large increase in unemployment, which has been typical of other tightening cycles. So.
Let's go to Chris.
Hi, thank you. Chris Rugaber at Associated Press. When you look at the disinflation that has taken place so far, do you see it mostly as a result of what some economists are calling the low-hanging fruit, such as the unwinding of supply chain snarls and other pandemic disruptions, or is it more a broad disinflationary trend that involves most goods and services across the economy? Thank you.
So if I understood your question, I would say it this way. I think we knew from before when we lifted off, but certainly by the time we knew that bringing inflation back down was going to take, as I call it, the unwinding of these distortions to both supply and demand that happened because of the pandemic and the response. So that unwinding was going to be important. In addition, monetary policy was going to help. It was going to help supply side heal by cooling demand off, and just in general, better aligning supply with demand. So those two forces were always going to be important. I think it's very hard to pull them apart. They work together. I do think both of them are at work now, and I think they're at work in a way that shows you the progress that we are seeing.
Let's go to Mike.
Michael McKee from Bloomberg Television and Radio. In June, you forecast a 5.6% year-end median Fed funds rate, and since then, you've more than doubled your growth forecast. You lowered your unemployment forecast significantly. So what would justify that last move? Because the median forecast is for lower inflation. And given all the known unknowns that you face, how much confidence do you have, can investors have, or the American people have in your forecasts?
Well, forecasts are highly uncertain. Forecasting is very difficult. Forecasters are a humble lot with much to be humble about. But to get to your question, though, what's happened is growth has come in stronger, right? Stronger than expected, and that's required higher rates. Unemployment, you also see that the ultimate unemployment rate is not as high, but that's really because of what we've been seeing in the labor market. We've seen more and more progress in the labor market without seeing significantly higher unemployment. So we're continuing that trend. In terms of inflation, you are seeing the last three readings are very, very good readings. It's only three readings. We were well aware that we need to see more than three readings. But if you look at June, July, and August, you're looking at really significant declines in core inflation, largely in the goods sector, also to some extent in housing services, and just a little in non-housing services. Those are the three buckets. Headline inflation, of course, has come way down, largely due to lower energy prices, some of which is now reversing. So I think people should know that economic forecasting is very difficult, and these are highly uncertain forecasts. But these are our forecasts. We have very high quality people working on these forecasts, and I think they stand up well against other forecasters. But just the nature of the business is the economy is very difficult to forecast.
Given the forecast that you have, what justified not moving today, and what could justify moving in the future if you think inflation is coming down? In other words, why did you leave that extra dot in?
Well, I think we have come very far, very fast in the rate increases that we've made. And I think it was important at the beginning that we moved quickly, and we did. And I think as we get closer to the rate that we think, the stance of monetary policy that we think is appropriate to bring inflation down to 2% over time, the risks become more two-sided. And the risk of over-tightening and the risk of under-tightening becomes more equal. And I think the natural common sense thing to do is as you approach that, you move a little more slowly as you get closer to it. And that's what we're doing. So we're taking advantage of the fact that we have moved quickly to move a little more carefully now as we sort of find our way to the right level of restriction that we need to get inflation back down to 2%.
Jennifer.
Thank you, Chair Powell. Jennifer Schonberger with Yahoo Finance. With your focus on year-over-year PCE, isn't it true that base effects are huge and that by the time you meet in November, that it's more likely that you'll have a low PCE number that would make you feel more comfortable? And secondly, how would the lack of key indicators like CPI, the jobs report, impact your approach in upcoming meetings if we were to have a government shutdown? Thank you.
Yeah, I missed the first question. What was the miss? What factors?
The base factors.
Base factors. Okay. So on that, we're looking at just monthly, right? You can look at just monthly readings and see what the increase was from the prior month. So you're right. When you go back 3, 6, and 12 months, you get base factors, but we can adjust for that. In terms of not getting data, again, we don't comment on government shutdowns. It's possible if there is a government shutdown and it lasts through the next meeting, then it's possible we wouldn't be getting some of the data that we would ordinarily get, and we would just have to deal with that. And I don't know. It's hard for me to say in advance how that would affect that meeting. It would depend on all kinds of factors that I don't know about now, but it's certainly a reality that's a possibility.
But would you feel more comfortable on the base effects that as those kind of fall out of the equation for the next couple of readings by November, would you feel more comfortable at that point?
Yes. I mean, if you're looking, we can tell how much inflation has gone up in a given month, right? And that's what we're looking at. And month by month, what's the reading? And I think what we're really looking at is there's a tendency to look at shorter and shorter maturities, but they're incredibly volatile and they can be misleading. That's why we look at 12-month. But I think in this situation where it looks like we've had a bit of a turn in inflation starting in June, we're also looking at 6 months and even 3 months, but really 6 months inflation. So you're looking at it over that period and over longer periods. That's the right way to go. And we don't need to be in a hurry in getting to a conclusion about what to do. We can let the data evolve.
Thanks for the question, Chair Powell. Edward Lawrence with Fox Business. So I want to focus back in on oil prices. We're seeing oil prices, as you mentioned, move up, and that's pushing the price of gas. So how does that factor into your decision to raise rates or not? Because the last two inflation reports, PCE and CPI, we've seen the overall inflation has actually risen.
Right. So, energy prices are very important for the consumer. This can affect consumer spending. It certainly can affect consumer sentiment. I mean, gas prices are one of the big things that affects consumer sentiment. It really comes down to how persistent, how sustained these energy prices are. The reason why we look at core inflation, which excludes food and energy, is that energy goes up and down like that, and it doesn't. Energy prices mostly don't contain much of a signal about how tight the economy is, and hence don't tell you much about where inflation's really going. However, we're well aware, though, that if energy prices increase and stay high, that'll have an effect on spending, and it may have an effect on consumer expectations of inflation, things like that. That's just things we have to monitor. So.
On the consumer, they're putting more and more of this on their credit card. The consumer seeing record credit spending. How long do you think the consumer can manage that debt at higher interest rates now? And are you concerned about a debt bubble related to that? So to finish my prior thought, I was saying that's why we tend to look through energy moves that we can see as short-term volatility. Turning to consumer credit, of course, we watch that carefully. Consumer distress, measures of distress among consumers were at historic lows quite recently, during and after the pandemic. They're now moving back up to normal. We're watching that carefully. But at this point, these readings they're not at troublingly high levels. They're just kind of moving back up to what was typical in the pre-pandemic era.
Jean.
Hi, Jean Young with M&I Market News. Yields along the Treasury curve have risen to their highest in years. What is the Fed's view about what's been driving that increase in recent weeks, and how much of it can be attributed to macro explanations and how much to technical factors? Thank you.
So you're right. Rates have moved up significantly. I think it's always hard to say precisely, but most people do a common decomposition of the increase, and the view will be it's not mostly about inflation expectations. It's mostly about other things, either term premium or real yields, and it's hard to be precise about this. Of course, everyone's got models that will give you a very precise answer, but they give you different answers. So, but essentially, they're moving up because it's not because of inflation. It's because it'll probably have something to do with stronger growth. I would say more supply of treasuries. The common explanations that you hear in the markets kind of make sense.
Kyle Campbell, American Banker. Thank you for taking the questions. Just two on housing. You've said slower shelter cost growth is in the pipeline and will reflect in inflation readings as new leases are signed. But there's also some questions out there about the way housing costs are measured, particularly the use of rental equivalents, which are estimates from homeowners about what their homes would rent for if they were in the rental market. So my question is, how much of the effort to tame inflation, both as it's measured and felt by the broader public, hinges on housing supply? And then as far as a constrained housing supply being sort of exacerbated by this sort of lock-in effect of mortgages being higher now than they were at their recent historic lows, how is that going to impact future thinking about taking interest rates to that lower bound in the future?
So on the supply point, of course, supply is very important over time in setting house prices and for that matter, rents. And supply is kind of structurally constrained. But in terms of where inflation's going in the near term, though, as you obviously know, a lot of it is leases that are running off and then being re-signed or released at a level that's not as high, it won't be that much higher. A year ago it would have been much higher than it was a year before. Now it may be below or at the same level. So as those leases are rolling over, we're seeing what we expect, which is measured housing services inflation coming down. Your second question was the lock-ins. How much is that affecting things, really?
Is that going to affect your decisions to potentially bring rates down to their lower bound in the future, sort of creating that sort of bubble of buying and then a lock-in that sort of stagnates the housing market?
I think we look at I would look at the lock-in, the idea being that people are in very low rate mortgages, and even if they want to move now, it would be hard because the new mortgage would be so expensive. And that's explaining that's one of the explanations for what's happening broadly in the labor market. Would that play a role in our future decisions in a future loosening cycle about whether we would cut rates? No, I don't think it would. I mean, I don't think that's. I think we'd be looking at what fundamentally what rates does the economy need, and in an emergency like the pandemic or during the global financial crisis, you have to cut rates to the point that you have to do what you can to support the economy. So I wouldn't think that would be a reason for us not to do that. It's not something we're thinking about at all right now, but down the road I wouldn't think so.
Nancy. Hi, Nancy Marshall-Genzer with Marketplace. Chair Powell, you've mentioned several things that would possibly weigh on consumer confidence, maybe cut back consumer spending, possible government shutdown, high gas prices. At this point, would the Fed welcome a decrease in consumer spending? Would that help you get inflation closer to your 2% target?
I wouldn't say it that way. We're not looking for a decrease in consumer spending. It's a good thing that the economy is strong. It's a good thing that the economy has been able to hold up under the tightening that we've done. It's a good thing that the labor market's strong. The only concern, and it just means this: if the economy comes in stronger than expected, that just means we'll have to do more in terms of monetary policy to get back to 2%, because we will get back to 2%. Does that answer your question?
Yeah, and I guess on the other hand, would you worry that could contribute to an economic slowdown or even a recession?
Well, that's always a concern. Concern number one is restoring price stability, because in the long run, that's something we have to do so that we can have the kind of economy we really want, which is one with sustained period of tight labor market conditions that benefit all, as I've said a couple times. So that said, of course, we also now, given how far we've come with our rate hikes and how quickly we've come here, we do have the ability to be careful as we move forward because of that consideration.
Simon.
Thank you, Chair Powell. Simon Rabinovich with The Economist. One of the factors in the economic resilience to date appears to be a lesser degree of rate sensitivity than in the past. Obviously, we've talked about households with long fixed-rate mortgages, also companies that refinanced before last year. What is your thinking about the efficacy of rates and how that's changed? And then related to that, how do you think about the distributional consequences in the sense that if you're a relatively wealthy household with a long fixed-rate mortgage, the past year has not been all that tough with rates going up, whereas if you're relying on your credit card for supporting your consumption, in fact, times are getting a lot tougher, a lot more quickly. Thanks.
So I guess it's fair to say that the economy's been stronger than many expected, given what's been happening with interest rates. Why is that? Many candidate explanations. Possibly a number of them make sense. One is just that household balance sheets and business balance sheets have been stronger than we had understood, and so that's spending is held up and that kind of thing. We're not sure about that. The savings rate for consumers has come down a lot. The question is whether that's sustainable. It could just mean that the date of effect is later. It could also be that for other reasons, the neutral rate of interest is higher for various reasons. We don't know that. It could also just be that policy hasn't been restrictive enough for long enough. And there are many candidate explanations. We have to, in all this uncertainty, make policy. And I feel like what we have right now is what's still a very strong labor market, but that's coming back into balance. We were making progress on inflation. Growth is strong, but I think by many forecasts, many forecasts call for growth to moderate over the course of the next year. So that's where we are, and we have to deal with what comes. On your second question, your second question was distributional, but can you be a little clearer about that?
My point there was that if you're somebody who has a long fixed-rate mortgage, you've been able to endure the higher rates relatively easily. If you're somebody who's living month to month off of your credit card, current financing rates are punitive.
Yes, and so the point I would make there is that we're trying to get inflation back down. The people who are most hurt by inflation are the people who are on a fixed income. If you're a person who spends all of your income, you don't really have any meaningful savings. You spend all your income on the basics of life: clothing, food, transportation, heating, the basics. And prices go up by 5%, 6%, 7%. You're in trouble right away. Whereas even middle-class people have some savings and some ability to absorb that. So it is for those people, as much as for anybody, that we need to restore price stability. And we want to do it as quickly as possible. Obviously, we would like to do that. We'd like the current trend to continue, which is that we're making progress without seeing the kind of increase in unemployment that we've seen in past things. But you're right, though. When we raise rates, people who are living on credit cards and borrowing are going to feel that more. They are. And of course, people with lots of savings also have a much lower marginal propensity to consume, and so it's not going to affect them as much.
Let's go to Greg Robb for the last question.
Thank you, Chair Powell. Greg Robb from MarketWatch. In the Beige Book recently, you can tell that the Fed has been surveying nonprofits and community groups about the economic health of low-income Americans, moderate-growth Americans. I have two questions about this. Are you going to use that data to maybe come up with a quarterly survey of those groups, like the Senior Loan Officer Survey, And from your, and also the second question is, from your recent readings of these surveys, how are low and moderate Americans doing? Is there this thing where like the GDP is strong because of wealthy Americans kind of driving things? And just want to get your sense of the health of that sector. Thank you.
So I don't know about the quarterly survey. That's an idea we can take away and think about. In terms of how low and moderate Americans, they're clearly were suffering from high inflation. I think during the pandemic, the government transfers that happened were very meaningful. And if you know the surveys that we take showed that low and moderate income people were actually in very, very strong financial condition. I think now it's a very hot labor market, and you're seeing high nominal wages. And you're starting to see real wages are now positive by most measures. So I think overall households are in good shape. Surveys are a different thing. So surveys are showing dissatisfaction, and I think a lot of that is just people hate inflation, hate it. And that causes people to say the economy is terrible, but at the same time they're spending money. Their behavior is not exactly what you would expect from the surveys. That's kind of a guess at what the answer might be, but I think there's a lot of good things happening on household balance sheets, and certainly in the labor market and with wages. The biggest wage increases having gone to relatively low wage jobs, and now inflation coming down, you're seeing real wages, which is a good thing. Thanks very much.
Jay Powell there, chair of the central bank that underpins, of course, the world's largest economy. I guess trying to do here on the tail end of this rate tightening cycle what he tried to do at the onset more than 18 months ago, and that is to guide market expectations to the same path that the Fed wants to trod. Our special coverage of the Fed Decides here on Bloomberg continues right now on the close as Team Surveillance right now passes the baton along to Scarlett Fu, along to Katie Greifeld, and along to myself, Romaine Bostick, as we take you to the closing bell and beyond. Guys, 13 FOMC meetings we've had, of course, going back to March of last year. 11 rate hikes coming out of those 13. We're back to pause, but Jay Powell wants you to believe that they're going to hike again this year.
Yeah, and it's made clear in the Statement of Economic Projections, right, where they see one more rate hike this year. They also revised up GDP forecasts for this year, while seeing lower inflation as well. What I found really interesting was Jay Powell's pushback that the SEP is not a plan. This is simply the median of all the individual forecasts that have been compiled, and he made clear that forecasts are highly uncertain. For anyone who's out there trying to craft a narrative based on all those projections, he's saying, you know what, this is hard work, and this is the best that we can come up with
no
right
one
now.
would ever craft a narrative.
No. But it's a reminder that monetary policy is an art, not a science.
Well, let's go. Sure, some people believe that. You sound like an economist. But let's just go through real quickly some of those numbers that we did get out of those projections. Basically, you're leaving the benchmark rate where it is, but making it clear in that dot plot. 12 of the 19 officials right now favoring another rate hike for this year, and they're saying they're going to raise their projections for 2024 as well as 2025. A revision higher on GDP expectations for this year and next, and a revision lower for the unemployment rate, which I thought was interesting, not only for this year, but for the next 2 years out.
And you marry those numbers into what we heard from the man himself in the press conference. This moment really stuck out to me when asked if a soft landing.
Was it when he pulled out that iPad?
That was pretty good. I do have a lot of questions about that.
It was the best advertising Apple's had in years.
You didn't see the stock pop, but in response to a question whether a soft landing, whether it's safe to call that the baseline, he said that he wouldn't call a soft landing the baseline expectation. Yes, it's their primary objective. It's possible, but not the baseline. But then back to Scarlett's point, you take a look at those revised numbers, it kind of looks like they're projecting a soft landing.
But don't read too much into that.
I'm trying not to.
Yeah, I think, though, he wants the market, I guess, to at least have enough sense of urgency that, another hike is going to come, but at the same time, have enough confidence that the economy isn't going to fall off the cliff. It was interesting to see the market reaction, of course, course, we talk about stocks at one point. Just a few minutes ago, we're at session lows. And, of course, you had that 2-year yield, which everyone's going to be talking about, camped out at the highest level since '06.
Yeah, moving up, up, at least in the aftermath. It came back down a little bit, but still remains higher, 5.135%. That's the highest in a couple years.
Let's walk you through some of the cross-asset price action. Abigail Doolittle standing by. Abigail.
Well, Romaine, this Fed meeting certainly not a snooze fest. And from a cross-asset class standpoint, lots and lots of movement. And I would say that if we were to title the overall meeting higher for longer, take a look at the 2-year yield that you were just talking about. So when the decision came out and the sense that they will be raising at least one more time this year, plus the dot plot being raised for the subsequent years, hotter economic projections, up, then down, and now higher, and at the highest level since 2006, essentially signaling that the market is taking the Fed seriously on the idea that they are going to be staying higher for longer. Similar message for the Bloomberg Dollar Index. Rising rates will support the Bloomberg Dollar Index. And from a technical standpoint and a longer-term standpoint, the Bloomberg Dollar Index is breaking out, suggesting that the rates rising that we're seeing today, that this trend, not just today, over the last several weeks, months, and even years, over the last 2 years, is going to continue. Now, you're talking about stocks. This is interesting because the NASDAQ 100 overnight really treading water, basically into the meeting even treading water, but at this point down 0.8%. So investors, stock investors also taking seriously the message that more money coming out of the system and that valuation, especially for big tech like this, could be made more precarious. If we go to other indexes, we are going to see stocks, I think, basically at the lows. The S&P 500 down 0.5% now, heading toward its third down week in a row. Small cap also down 0.4%, I think below its 200-day moving average. The SOX down 1%, and then that New York FANG index down 1.3%. A hawkish pause, higher for longer. One of those characterizations does seem to be appropriate, or maybe both, for this meeting.
The market reacting right now. Of course, the Fed back in July did hike rates, putting them back on pause today. Jay Powell making it clear that the decision to hold today is based on how far we've come. Take a listen to some of the other comments that he just made at that press conference.
Real interest rates now are well above mainstream estimates of the neutral policy rate, but we are mindful of the inherent uncertainties in precisely gauging the stance of policy. We're prepared to raise rates further if appropriate, and we intend to hold policy at a restrictive level until we're confident that inflation is moving down sustainably toward our objective.
The chairman of the Federal Reserve speaking just a little while ago, a little bit earlier today. Bloomberg opinion columnist Bill Dudley said that there were going to be 5 key things that he was watching in today's Fed forecast, including will there be another rate hike this year? What's the outlook for unemployment? How low can unemployment go without stoking inflation? And what's the neutral Fed's funds rate? And when will rates start coming down? Now that the forecasts are out, let's bring in Bill Dudley, joining us right now, former New York Fed president, former vice chair as well, and over at Princeton University Senator for Economic Policy Studies. And let's start with the neutral rate, because this seemed to be one part of the press conference where he seemed to struggle a little bit in articulating exactly how they're going to assess when they think they've finally arrived at that rate.
I think the message of the meeting was basically 2 things. Number one, a soft landing is more likely, because you can see the unemployment rate only has to rise now to 4.1% to get the job done. Back in June, it had to rise to 4.5%. And number 2, economy stronger than expected, and therefore, while policy is probably not as tight as we think it is. So there have been a little bit of an upward movement in people's estimates of the long-term federal funds rate in this summary of economic projections, first in June and again this month. So what basically the Fed is concluding is maybe monetary policy is not quite as tight as we think it is, but they're also very, very happy about how the labor market's unfolding. They basically think a soft landing is more likely, quite a bit more likely. I'm a little surprised by the market reaction. I think the market reaction should be bond yields up because the Fed's going to be tighter for longer. Stock price is sort of mixed. Higher bond yields weighing on stock prices, but more chance of a soft landing. That's a good thing for stock prices. So I'm a little confused by the market reaction.
That's interesting. You mentioned the stock market reaction, because one point you make in your column today is that keeping a rate hike in the forecast, you write, has the tactical benefit of restraining markets, which might otherwise decide that we're done and generate an unwanted easing in financial conditions. Bill, you've been in the room before during these discussions. How mindful are policymakers of the market's tendencies to immediately make assumptions off of each clue that's dropped?
the market's always searching for what the Fed's going to do from anything, from the statement, from press conferences, from speeches. So I do think keeping one rate hike in the forecast does sort of, keep the market from running away from the Fed. But as Chair Powell mentioned in his press conference, it probably doesn't really matter that much at the end of the day whether they do that rate hike or not. It's not like the economy is going to turn around dramatically if the Fed does a quarter point more or a quarter point less. I think the way he's trying to explain why they might do another quarter is to make themselves more confident that they're going to achieve their objective. So let's imagine the data is sort of ambiguous as we go through the next couple of months. So if it's ambiguous and the Fed's not really sure that they're actually going to achieve their objective in a timely way with the current level of rates, you do one more rate hike to try to increase your level of confidence. So at this point, it's not really about, do they have to go another quarter or not? It's really more about would going another quarter make them more confident that they're going to have the outcome that they seek.
And Bill, beyond whether or not they're going to hike one more time or not, I think it was interesting that they actually took a few cuts out of next year's forecast. When you think about the expectations for 2024, what should we read into that? Is that the soft landing perhaps coming into fruition, or should we take that as maybe inflation is going to continue to be a problem here?
Well, they didn't really change the inflation trajectory very much. So I think the way I view taking the rate cuts out is the fact that the economy is just stronger than expected. If the economy has more momentum, I don't need to support the economy as much with rate cuts. So I think that's really the message, because the inflation forecast didn't really change in a meaningful way.
We're in conversation right now with Bill Dudley, Bloomberg opinion columnist, and of course a former chair of the New York Fed. Want to bring into this conversation our very own Michael McKee, our chief international and economics correspondent here at Bloomberg, who actually wants to participate in this conversation. Mike, take it away.
Yeah. Well, let me tell you what I take out of this press conference, and then I want to ask Bill what he thinks, because he's the central banker and he has a much better idea than I do of what they're talking about in the room. But it seems to me that there's a bit of an internal inconsistency in their forecasts, in that they've more than doubled their growth forecast. They significantly lowered their unemployment forecast, and yet inflation is supposed to come down. So are they saying at this point that the stronger growth we've seen is not inflationary? And my takeaway from that would be they're done, but they're leaving that extra rate increase in before the end of the year as an insurance policy. And the same sort of thing holding true for the cuts they took out last year. If the economy were to produce inflation, then they have something in there that they can point to the markets and say, we did this. Bill, is that kind of the way people should take this?
I think that's the way people should take it. I mean, I think it's very interesting that before they had the unemployment rate going up to 4.5%, now the unemployment rate only has to go up to 4.1% to do the job. What that's telling them is they're taking quite a bit of signal of the fact that the labor market seems to be getting to better balance, even without the unemployment rate rising very much. So they're more confident that the labor market can essentially normalize on its own, that the Fed doesn't have to generate as much slack in the labor market to get inflation back down to 2%. So it's and Chair Powell talked about the increase in labor force participation. He talked about the fact that the ratio of unfilled jobs to unemployed workers has come down. So they're taking quite a bit of positive signal about how the labor market is developing.
Well, if the economy develops ambiguously, as you say, over the next couple of months, would you be surprised if they raise rates again?
I think at this point they probably think that they will not have to, but they know that if they're going to move in one direction or the other in the next few months, it's definitely a rate hike, not a rate cut. So I think it's going to depend on how the data unfolds. And as the press conference, there's a lot of discussion in the press conference. There's a lot of shocks hitting the economy right now. Government shutdown, auto workers strike, the beginning of student loan repayments, oil price shock. So I think the Fed may actually have the government data in terms of the economic releases if the government shutdown goes on for any length of time. So I'm going to be very surprised if they hike in November, and then we'll see where we are at the December FOMC meeting.
Yeah, we'll see where we are, and that's something that Powell made extra clear. They're going to proceed carefully, cautiously. Bill Dudley, thank you so much. Bill is Bloomberg opinion columnist, senior advisor to Bloomberg Economics, and of course, a former New York Fed president. And of course, our thanks to Bloomberg's Michael McKee in Washington. Here in New York with us right now to continue the conversation after the Federal Reserve policy setting meeting is Torsten Slok, partner and chief economist at Apollo. It's so good to see you here in studio today. Did Jay Powell come across to you as hawkish or dovish?
Well, I think the clear signal they want to send here is that we need to slow this economy more down. I mean, they could have decided to hike rates today. Obviously, that was not market expectations, but I think this was a very hawkish pause. I mean, the whole communication, the way that the statement was written and changed, and what he said at the press conference, it clearly signaled that we can allow ourselves to keep rates higher for longer, and taking 2 cuts out of next year, by definition, means that rates will be higher for longer. And the fact that, as Bill Dudley just mentioned, the fact that this is happening without any increase in the unemployment rate today is 3.8, and now they see it going up to 4.1. That's really almost a rounding error. So saying the labor market is just not going to change in their forecast, that is quite incredible, in particular when they at the same time say we're worried about inflation, and they're really saying we're worried about inflation being too sticky, and therefore the risk that inflation might not come down to 2%.
Well, Torsten, seizing on the idea that higher for longer is really the takeaway from this decision, from this presser, I want to go right to your notes, because you wrote before the decision that rates and therefore the cost of capital are going to stay elevated for another 9 to 12 months, and credit and equity investors should plan accordingly. What should that plan look like? Because I look at the equity market this year, I see it double digits higher, look at credit spreads, and they're pretty tight.
I know, but what's going on, and he was asked about this also, is that you're seeing both for consumers and for firms, higher interest rates or higher cost of capital are beginning to bite harder and harder. We're beginning to see delinquency rates going up for consumers on credit cards and auto loans. We're beginning to see default rates going up on high yield. If we are going to keep rates at these levels for another 9, 12 months, we should be extrapolating the current lines for what's going on with delinquency rates and default rates. And that runs the risk, in particular in high yield, where default rates are now up to 4.3 in the data for August that just came out, that could continue for the next 6, 9 months. And that's then going to open up a risk that if we begin to see the cost of capital bite harder and harder on companies every single day that cannot either get a new loan or refinance an existing loan, we begin to run the risk, of course, that we'll begin to see more companies defaulting. And on the consumer side, more people falling behind on their payments. He was asked about, are you worried about delinquency rates going up for consumers? And he said, oh, this is just a normalization. But I think the important thing here is, why is it normalizing? Because interest rates have gone up. So I do think that high interest rates are biting both on consumers and on corporates, and they're going to allow that process to continue now for potentially even not only the next 9 to 12 months, but maybe even the next 18 months, because they're going to keep rates higher. And I think that process is exactly what I would call the crystallization of the transmission mechanism of monetary policy, trying to slow the economy down gradually more and more. And that's the process that we're seeing across the board, both for consumers and corporates.
And Powell really did make that correlation, maybe not explicitly, but as explicitly as we're ever going to get out of a Fed chair, when he did talk about this idea that if the economy strengthened or did perform better than what was already in their projections, then we were going to get more hikes here. So he's basically sending that message loud and clear that at least the economic activity we're at right now, that might actually be the baseline, or I should say maybe the top line.
Absolutely, because think about it in credit markets. We are every single day when interest rates and cost of capital, as Katie has just highlighted, are at these high levels. This is having real implications. There are real firms that need to roll over loans. There are real firms that need to think about, do they want to have a new loan? And if the cost of capital stays at these levels for another year, that means that for the next 3, 4 quarters, we are likely to see the increase in default rates, in particular for lower rated companies in loans and in high yield, continue to slowly grind higher. And this becomes a difficult process to manage for them, in particular if this starts to spread. Remember, there's about 11 million people who work in the companies that are high yield issuers. So that means that from a total employment perspective, there's potentially a lot of people in the high yield industries that are at risk of losing their jobs if this default cycle continues.
I'm curious, when you looked at the SCP numbers today, the economic projection numbers today, are they pretty much in line with your own outlook?
Yeah, I would also expect the summary of economic projections, as it said, that things are still okay for now, but they are projecting, and that's also what I would expect, that's also what the consensus is expecting, they are expecting that things gradually continue to slow down. Remember, they have two goals, of course. They have inflation and they have employment, and you need to have a soft landing, not only in inflation, we are well on track there, but we also need a soft landing in the labor market. And the fact that they are almost saying that we have almost achieved a soft landing because the unemployment rate is very close to the end goal where they think it will be in 2 years, that's saying that we can get inflation down with no implications for the labor market. That would be quite remarkable when you at the same time think about how companies, as we speak, are seeing default rates going up, in particular, again, for lower rated credits with higher leverage and lower interest coverage ratios.
All right, Torsten, really appreciate your time. Great to see you on set with that instant Fed analysis. That is Torsten Slok of Apollo. Meanwhile, you take a look at these markets. Stocks down, yields up. Bloomberg's Jess Menton standing by with a check.
Okay, Katie, Romaine, and Scarlett, taking a look at the S&P 500, the round trip it's made since the Federal Reserve first began raising interest rates in this cycle back in March of 2022. If you look in that span, the S&P 500's up close to about 4% in that time frame. But also, if you look back where it bottomed in October of last year, up well over 20%, actually around 23% at this time frame. But if you're looking at where things are trading today, not a ton of movement as stocks have been fluctuating this afternoon. Typically, historically, over the past 3 decades, the stock market, usually on Fed days, the S&P 500 does end flat. But going through today, there actually has already been 101 trading days since the last time the S&P 500 has seen a decline of at least 1.5%. So today would mark 102 trading sessions. That's the longest streak since 2018. So it's going to be interesting to see. Apparently, this wasn't necessarily the catalyst that investors may have been expecting to see a downward decline there, but something to definitely keep an eye on. Katie, Romaine, and Scarlett.
Jess, great roundup. Really appreciate it. And you know it's a big day because Bloomberg Intelligence Chief U.S. Interest Rate Strategist Ira Jersey is in the New York office coming up from Princeton. And Ira, it was really interesting listening to Jerome Powell. He brought up real yields multiple times. Just to go through some of the headlines here, he said that real interest rates are, quote, meaningfully positive now, and also that they need to stay positive for, quote, some time. When you think about where real rates are right now, you think about 5-year real rates well above 2%. How much of a tightening impulse is that doing for the Fed?
Yeah, I think that the tightening and the real rate environment is exactly where the Fed wants it. So I think the question becomes is how long do they keep it there? And then what happens if, say, inflation continues to come down a lot and therefore real rates just are even higher, right? So one of the things that we looked at in a note this morning was where the market is pricing the expectation for the real Fed funds rate a year from now. And basically where the market's thinking that actually real rates are going to come down a little bit because this morning anyway, or last night when I put the piece together, everyone thought that the Fed might, be cutting interest rates a little bit more than they think now, right? But I think that the fact is that the market still wants and still believes that the Fed is going to be able to hold the policy rate above inflation for at least the next couple of years.
One question I thought was really interesting was the question on the efficacy of rates. This idea that households and businesses that should be hurting more from the steady increase in rates have actually done okay, in large part because they locked in lower rates, either through 30-year fixed rate mortgages or refinancing before the Fed began raising rates. What did you think of Chair Powell's explanation about how just balance sheets are healthier than we might have expected?
Yeah, so he didn't mention this directly, but it all goes to the long and variable lags argument, right? So it's just a longer and maybe more variable this time, in large part because of what you just noted, right? A lot of basically the terming out of debt, both by the household sector and the business sector, and it's something that's basically been going on since the late 1990s. So this is a generational shift. It just means that it's going to take monetary policy longer to work. It's not that monetary policy won't work. It's just that it takes much longer to feed through the system. When 25% of corporate debt was in commercial paper, and it was all 2- and 3-month CP, that affected the market immediately. Yeah. There's no more CP as a share of corporate funding, right? So it's not going to affect businesses and business activity as much now. But over time, you have less CapEx, right? Because maybe you're not willing to borrow a little bit more to do that capital expenditure that you would have. But again, that's a much longer, that's a 3, 4, 5 year type of activity rather than, 3 months or a year.
All right, Ira, great to catch up with you here, Ira Jersey, over at Bloomberg Intelligence, the chief U.S. interest rate strategist there as we continue our special coverage of the Fed Decides here on this Wednesday afternoon. We continue to count it down to the closing bells as well, which are just about 14 minutes away. And Ira, we want to actually keep you here, Ira, if you can, before we let you go, because you're so good. We decided to ask you additional questions. And I do have one question here about the idea that how many people were betting on the steepening of the curve, meaning investors in the market. And when you looked at the dot plot and the economic projections here, do you think that's going to be enough ammunition to actually see a significant unwind in some of those bets?
Yeah, so I think that's actually one of the reasons you've seen some of the what we call bear steepening over the last couple of weeks, which is people thought that maybe the Federal Reserve was going to cut interest rates pretty aggressively next year. And because of that, you wind up with 2-year yields rallying a lot and 2-year yields much lower. And that was the interest rate, the steepener, and that was a consensus for a while. And I thought that for a little while too, although I backed off from that the last couple of months. So I do think that some of the move that you're seeing today are people saying, okay, well, look, if the Fed's on hold, 2-year yields aren't going to go down a whole heck of a lot.
I want to follow up on that too, because I mean we're something like 18 months from when we first started this cycle, and really close to 2 years when you consider when you started to try to jawbone the market. Your expectations when you go back maybe to late 2021, early 2022, compared to your general expectations now here, did they shift meaningfully?
Well, yeah, of course, because we wound up getting much higher inflation than we thought, right? We were thinking that 10-year yields would peak somewhere under 4%. We've obviously peaked above 4%. The challenge with managing money and trying to determine where interest rates are going to go, particularly longer-term interest rates, it has to evolve, right? So getting direction right ends up being much more important than getting the magnitude right, because you can always stay in a trade longer if it's working than getting it wrong and getting stopped out or losing a lot of money, right? So we thought that yields were going to go up in 2022, right? That was a pretty consensus view. Yeah. But we thought again like 3.3%. Now it's 4.3%. I do think, though, overall, you have to think about, for the longer end of the curve, are we near or at the peak of interest rates? And I think we probably are, but there is a big risk here because we've tested this 4.35% on the 10-year. Yeah. If we break through that, there's going to be a lot of stops where a lot of people like buying at like 4.25, but if you get to 4.5, those people are going to get out of that trade, and you wind up with a big spike in interest rates.
What would be the impulse for long-end rates to go higher, for the 10-year specifically to reach 4.5? What would be the actual catalyst to drive it there?
Yeah, I think it would have to be a reacceleration of inflation. So basically CPI and the core PCE deflator moving up a bit. And then as that occurs, basically even more shifting of expectations for what the Fed's going to do. So I think in order to see, a 5% 10-year, you probably need to have expectations of a 6% Fed funds rate or higher, just because the market is going to continue to think that at some point the Fed will cut interest rates. But if the Fed is still hiking interest rates, then you wind up having a significantly higher 10-year yield as well. So another 50 basis points or 75 basis points of hikes by the Fed, that might get you close to 5% on a 10-year. Now, that's not our base case expectation, obviously, but that's probably the likely market outcome of that scenario.
All right, Ira, now you can go.
Thanks, Roman.
I think the Amtrak trains are back up and running. Bloomberg Intelligence Chief U.S. Interest Rate Strategist Ira Jersey there, helping us walk through not only his take here on those economic projections, guys, but more importantly, how the market might react should some of those projections get hit. And of course, the big move today is in that 2-year yield, the most rate-sensitive part of, at least the main part of the curve here, up 7 basis points right now, 5.1587 and change.
The highest level since 2006. We also have the 10-year yield moving marginally higher. One thing that we were trying to figure out yesterday was the big move up in yields as well. And there are different reports, but Canadian CPI picking up, quickening in August after it had appeared to stabilize, raising some concerns that we're going to see a similar reacceleration of inflation here in the U.S. because the Bank of Canada was ahead of us with the hawkish pause.
Yeah, and it's interesting too. I mean, we talk about the equity market reaction. We're still around session lows here for most of the major equity indices here. And I was just looking at the S&P sectors, and basically what's leading it right now is consumer staples and healthcare and in real estate.
Mm-hmm. And then you take a look at the NASDAQ 100, your big tech names. The NASDAQ 100 off by 1.2%. I thought it was interesting. It was Bill Dudley, right, who said that, okay, if you take a look at what the expectations are, rate cuts coming off the table next year, shouldn't stocks be higher?
Yeah,
right
he was
now?
puzzled by that for sure. I mean, big tech is, so, maybe that should lift the markets overall. Let's not forget that we do have earnings coming out after the bell.
Yeah.
There's still corporate news, and FedEx will be reporting. We'll be all over that.
Yeah, we're going to get FedEx, and I see you got Clavio up there. It's a debut here on the day. Let's continue this conversation right now as we count you down to the close. Jeffrey Rosenberg joining us right now, BlackRock portfolio manager of the Systematic Multi-Strategy Fund. And Jeff, I just want to get your take right off the top here. When you heard the commentary from Powell at the press conference and kind of the back and forth with regards to where rates might be, where the neutral rate might end up here, this seemed to be just once again him trying to work that magic on the market and keeping their expectations in line with the Fed's expectations. Do you buy into it?
Well, I think that, most of the action in this meeting, comes from the statement of economic projections. And as Powell, tried to lay out, that's not part of the committee's deliberations. It's not a plan, but it is really, the signaling of each individual participant's, expectations. And so that was really the dominant story. And so Powell had to kind of navigate that. But I think it was a story that he wanted to tell, particularly in showing, higher or restricted for longer in terms of the 2024 dot. The 2023 did not have the decline. So overall, it preserves a lot of policy flexibility to become less restrictive over time. And I think that's the easier path for Powell to have taken. And I think that's probably a good outcome for him and the FOMC today.
Less restrictive over time would suggest that current policy is sufficiently restrictive. And I fixate on that clause, that phrase, because that's a qualitative, not quantitative judgment, isn't it? What does sufficiently restrictive mean in the current context? Is it a moving definition or range, or is it a fixed target during this rate hike cycle?
Yeah, and as you saw, there was a lot of discussion and a lot of questions on that. And I think the answer is sort of you know it when you see it, which is that the policy rate has the impact on the data, on the economy, and most importantly on inflation that they're expecting. So, most of the forecasts that were written down today, and most of the market forecasts basically say the Fed's going to have success here on inflation, and so therefore we're sufficiently restrictive, and we're about to move the discussion to, are you too restrictive? What about cuts in 2024? Why did you take 50 basis points out of the cuts in 2024? But that may be premature. It's basically, counting your chickens before they've hatched in the form of we're expecting that inflation decline. And if we don't get that expected decline, that's going to be a bigger surprise, noting that, we've had a lot of failures in the consensus forecasting around inflation. Now it's too benign. Now the market is too complacent around the expectations that inflation will go back down to its pre-COVID level. I think that's where the surprise in the forecast may come from. But right now, there's pretty good consensus both at the Fed, in the SEP, and in the market that inflation has been won. The war on inflation has been won, and it's just not as Powell laid out in part of the Q&A. Now it's more two-sided and trying to secure that soft landing that is so much in the consensus, and I think is also reflected, partly in these SEP forecasts as well.
So, Jeff, how high is the hurdle for a rate hike in November? And he himself said that, it probably wouldn't do anything for the economy.
Yeah, I mean, as he said, and I think it's right, one more hike here is not really the make or break story. The story is really that they're going to be high for longer, restricted for longer. We're pretty much at the end of the hiking cycle. Whether there's one more or not, very much depends on how strong the economy is. And as he highlighted, the change from the prior forecasters really about the strength in the economy, contributing to people's unease about how quickly they had penciled in cuts in 2024. So that's really going to be the story here going forward is, does the strength persist? Does inflation not fall as much as forecast because of that strength? And the Fed actually needs to do more or hold at the higher rate. Well, both needs to do more in the form of one increase, but then hold at that higher rate for a longer period of time into 2024.
And Jeff, I'm still stuck on Chair Powell's comments on real rates, these meaningfully positive real rates. And just to recap what we've seen so far in 2023, you have 10-year real yields up about 45 basis points. You look at the S&P 500 up about 15% so far this year at the moment. I know that AI is very exciting, but when does the U.S. equity market start to respect what we're seeing in the bond market?
Well, the discussion on real rates is very interesting because, both you have an increase in kind of the projected real rate into 2024 with the 50 basis points of cuts in nominal rates being taken out at the same time as you basically maintain the inflation rate decline. Yet the discussion also brought about the longer run estimate and effectively the discussion on, what is the real neutral rate. So, right now, estimates for the real neutral rate imply that these are very high and therefore restrictive real rates. But there is this possibility, and Powell talked about it. He admitted that, the resilience of the economy might point to the fact that your neutral rates are indeed higher, that post-COVID structural changes have led to that. And, that will be the kind of historical reckoning of this tightening cycle, that if real rates indeed did go up, that we actually weren't as tight as that as we expected in real time. And that might explain the lack of the inflation decline down to the 2% level. Sort of the easy parts of inflation declines are behind us. The hard part is ahead of us. And whether we achieve that as easily as these forecasts in the SEP are implying very much depends on whether or not these real rates are as tight as we think they are today.
All right, Jeff, going to have to leave it there. Jeffrey Rosenberg over at BlackRock. He basically made it clear here, guys, that I thought he used the phrase here, the hard part really is here. And I just want to quote something. Enda Curran, one of our Bloomberg reporters here, wrote something great in the live blog that we had. And he basically said, it's clear, in his words, it's clear the Fed is now in a much more, quote, complicated judgment territory than it has been. And he goes on to talk about this idea that when you go forward, these next few meetings, it's going to be insane.
What do they say about script writing, that the third act is the hardest?
I don't know. I've never taken a script writing class. What are you doing in your free
Maybe
time?
I revealed too much about myself.
Yeah, what is the script about?
You think about how close the finish line is.
Does it involve me and Scarlett?
No, it's all about the Fed, actually.
Oh, is it?
Yeah,
Okay.
basically, and how hard it is, their path forward.
Hold that thought, Katie Greifeld. We're moving closer to these closing bells. Our full market coverage right here on Bloomberg as we take you to the bell and beyond.
Beyond the Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick alongside Katie Greifeld and Scarlett Fu. We're counting you down to the closing bell. We're here to help take us beyond the bell. It's a global simulcast with our friends Carol Masser and Tim Senovic. Welcome to our audiences across all of our Bloomberg platforms. Here on Fed Day, of course, the big headline, guys, is the Fed holding rates here at the September meeting, but making it clear in those projections that it expects rates to be higher for longer into 2024 and beyond.
Right, and it looks like, Romaine, that the Treasury trade certainly got that memo and that note and that message very clear. Your two-year note now at 5.15. I mean, we're at the highest in since 2006, I believe. So we've really seen kind of a bit of a reset again, I feel like, this week and certainly on this day when it comes to rate expectations. And we just talked with Larry Pitkaski over at Good Haven, and he said, I love what he said, I think we're in a higher rate, risk-free environment without existential worries. So in other words, higher rates for longer, get it, but maybe without some big risks.
But here's the thing. When you look at the summary of economic projections, how can you know what's going to happen in 2024? How can you know what's going to happen in 2025? You really, as Yelena Shaliatov over at BNP Paribas told us, you have to take anything beyond this year with a giant grain of salt. We just don't know what's going to happen.
So Scarlett, should it not be considered a plan then?
He was very clear that this was not a plan. These are the median, the average forecast among, all these different participants who submitted their numbers. And by the way, economic forecasting is very difficult, guys.
I've heard that before. I heard that today, actually, from Fed Chair Jay Powell.
I mean, not if you have a crystal ball. I don't know. Do you guys not have one?
Yeah, we don't. Let's walk you through the market numbers here. We've been talking a lot about the macro, but it was a pretty busy day for equity markets. Obviously on pins and needles about the Fed, but of course you had an IPO today in Klaviyo, and not necessarily the best trading day for Instacart and ARM once again. The net effect of it all is the Dow Jones Industrial Average lower by about 0.2%. The S&P 500 giving back almost 1% on the day, or roughly 41 points, a close right around that 40 4,400 level, a key technical level there. The NASDAQ composite down about 200 points or 1.5%, while the Russell 2000 looks like it's going to finish out the day lower by about 0.9%.
All right, quick look at the S&P 500 in terms of the names, about 173 to the upside, 328 to the downside, so certainly more of that risk-off trade, no doubt about it, and 2 unchanged, Scarlett.
Yeah, volume also slightly lower than the year-to-date average. Let's look at the sector performances here for the S&P 500. It was a down day for the major indexes, as Romain told us, but there are some sectors that did finish higher, including telecom names, healthcare equipment, and food, beverage, and tobacco. So you're seeing a lot of those dividend plays, those safety plays come out ahead. On the flip side, you've got a lot of those big tech names, media, entertainment, semi and semiconductor equipment companies, and tech hardware, along with software and services, all leading to the downside, all down by at least 1.5%.
All right, a little nervous, making sure that my gainers actually held on to their gains, but let's go to it. Klaviyo, right? The IPO. It's been a big week.
Not all of them did, Carol. Can we just get rid of that fourth one?
Darn it, gosh.
Yeah.
All right.
Can you just block out her box?
You know,
wow.
Again, I'm here. I can hear this. All right, so Klaviyo up about almost 32% at its highs today in its first day of trading as a public entity here, finishing up, though, with about a 9% gain. It was oversubscribed nearly, I think, 30 times. So, you know, it's interesting. Limited supply, another one of those kind of IPOs, but nonetheless, a gain, but lost a lot of that momentum that it saw earlier in the session. Pinterest, I want to go there because it's been on quite a 2-day rally, up another 3%. It gained 3% yesterday. Analysts were impressed by Tuesday's Investor Day, saying that the social networking company was upbeat and that the long-term targets look achievable. It's up roughly about 13% so far this year. And then Enphase Energy, once again, rallying up 4% yesterday, up another 1.5% today. News Monday, late Monday, after the close at co-director Thurman Rogers bought about $4 million worth of shares. It's the only news I could find, but it looks like still some momentum. Still down more than 50% year to date, and you got about 8% of the float shorted. Initially, a lot of other solar names were higher, which meant the Invesco Solar ETF was up almost 2% at its highs today, but finishing with a decline of 0.1%. So over to you, Mr. Decliner.
Handing it off to me. Okay, I'll take it. Let's talk about some of the stocks that moved lower on the day today. In the S&P 500, mega cap tech declining after the Fed's higher for longer message. Apple among the worst performers on a points basis in there. Microsoft there as well. Nvidia, Alphabet there as well. We should note that Dow Jones also reported a note from UBS's David Vogt that questioned demand for the Pro version of Apple's new phone, saying demand was not as strong as it was for the Pro models last year. And then Zebra Technologies, the worst performer on a percentage basis in the S&P 500, down 6.5% today. It's a company that makes barcode scanners, interactive kiosks, and more. Got downgraded to underweight from equal weight at Morgan Stanley. Morgan Stanley analysts writing that the pace of recovery at the consumer electronics company will likely be slower than expected. And then let's check in on Maple Bear. That's, of course, Instacart. The price for that IPO was $30. It closed today just above that IPO price. Yeah. So hung on to that, but still down 10.7% today. This after raising earlier this week, $660 million.
Do you know why it's Maple Bear?
No. Oh. Well, anyway.
Do we have something more important? Let's go to something more important.
Well, something more important, I would say, is the bond market. Yeah. I know there were some interesting single stock stories, but on Fed Day, of course, we got to take a look at what's happening across the Treasury curve, all the action in the front end. As you can see there, you have 2-year yields managing to rise 6-7 basis points, 5.15%. That is the highest 2-year yield since 2006. You go out the curve, not as interesting. You have 10-year yields. I'm going to call that unchanged. Your 10-year yield about 1 basis point higher, 2 basis points higher, 4.37%. That curve back to inverting rather at about negative 78 basis points remain.
Yeah, we actually still getting some earnings, believe it or not, here. That's kind of the last stragglers from the past quarter. FedEx out with their numbers here for their fiscal first quarter. Revenue coming in at about $21.7 billion. That's a smidge lower than what the street was looking for at 21.84. But operating income does look like a pretty solid beat at $1.59 billion versus a street estimate on average of about $1.34 billion. Here's your forecast here. The company basically saying that it sees full year adjusted EPS at $17 to $18.50 a share. The previous guidance it gave was $16.50 to $18.50. So effectively just raising the lower end of that range by about 50 cents. You can see the price reaction there, the knee-jerk reaction higher by about 2%.
And of course, when it comes to FedEx, what's notable, of course, is how it stands in contrast to UPS. UPS had to give big pay raises to its workers who had threatened to strike. FedEx, of course, is has been cutting costs and has been doing that. And the CEO says that they're well positioned to deliver, they've started fiscal 2024 with strong momentum and are well positioned to deliver improved profitability. So kind of just putting that out there and reminding everyone.
Yeah, they're not apples to apples when you look at FedEx and UPS. We often talk about their different models, but man, investors have been really sitting up and taking notice of what FedEx has been doing in terms of transforming the company. I mean, it's up more than 40% this year. You've got UPS down about 9%. They are, of course, have been, concerns with the striking, strikes and so on and so forth. So very different stories for these, but it really does feel like Wall Street investors have taken notice of what the changes they've made.
But it's interesting, too, to look at this report as well as a couple of the reports and to sort of tie that into some of the questions that Powell was peppered with here. This isn't a revenue growth story. I mean, this is cost cutting. And I think this is the fear that a lot of investors have that, that's great in the short term. It gets you through the quarter and it bolsters the stock price. But how much longer do we go like this, particularly if you do believe that rates are going to stay higher?
Yeah, the press release, Romaine, literally spells that out. It said that first quarter results improved primarily due to the execution of the company's DRIVE program and a continued focus on revenue quality. But, and this is a big but, the improvement in operating results was partially offset by ongoing demand weakness.
That's the thing. I mean, it's you can cut costs. No one's poo-pooing that, right? But you can't sort of cut your way to prosperity, more or less, right? And you sort of wonder what the strategy is for FedEx. And we don't want to just pick on FedEx here. A lot of other companies are in the same boat as them. Other blue chip companies are in the same boat as them. And I wonder if that's sort of the next thing that the Fed really has to be mindful of. We so focus on the consumer and the homeowner, but we forget there's stresses out there for businesses as well.
But maybe against this backdrop, that's good enough. And you can see that in the share reaction after hours, FedEx shares up 2.5%. To your point that, I mean, that's not necessarily growing, that's cutting costs. But you think about some of FedEx's peers, maybe cost cutting is good enough to make it stand out.
Well, and sometimes you have to clean house, right, to get to a better business strategy or business equation. I do also want to mention that, and this could be another reason why the stock is popping, company expects to buy back an additional $1.5 billion in shares during fiscal 2024. We see companies doing that a lot, when they've got some excess cash. Again,
so $1.5 billion to buy back the stock.
Right.
Not into CapEx, not into the business.
It's not building the business,
okay, gotcha.
Paying workers, whatever.
Okay.
But it allows you to buy time while you wait for things to recover, right? I mean, Jay Powell made it really clear that the economy is doing better and holding up better than a lot of people anticipated, certainly than the Fed anticipated. And so demand might be more muted than it was before the rate hikes, but it's held up for the most part.
No, you do wonder, right? You can't cost cut your way to, a really strong company, but you can certainly make investors happy, maybe for a little while. So more to come, certainly, on that story. Guys, that's a wrap. All right, that'll do it for our cross-platform coverage.
Happy Fed Day.
Happy Fed Day.
Good to see 5 of us.
Yeah.
Did Tim say big butt before?
No.
He did. You did. It's a big butt. You said that.
Oh, okay.
Sorry.
Maybe I did.
I know. I'm being like an 8-year-old again. That's a wrap. Our cross-platform coverage, radio, TV, YouTube, and Bloomberg Originals. We will see you again tomorrow.
Stick with us. A lot more coverage coming up here on Bloomberg Television, a reaction to what we learned out of the Fed today, a reaction to what we learned in markets as well. David Balin from Citi, John Taylor from Stanford University, and Raghuram Rajan, former India Reserve Bank governor. All that and more coming up in just a bit. This is Bloomberg.
The EU is one of the largest and wealthiest consumer markets in the world, and there are very few global companies that can afford not to trade in the EU. So as the price for accessing the European market, these companies need to obey European regulations. That's not surprising. But often these companies choose that they will extend the European standards across their global conduct and their global production because they want to avoid the cost of complying with multiple different regulatory regimes. So there are benefits to standardization, benefits to uniform production. So all the EU needs to do is to regulate the single market. It is then the market forces and the business incentives of global companies that transform that EU rule.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Messer and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals.
A down day for equity markets, an up day for yields, the most severe price reaction, the most severe volatility, of course, coming right around the 2 p.m. mark here in New York when the Fed released its decision. The big thing, though, the big takeaway, though, that we learned from that press conference from Jay Powell and from those economic projections is the idea that the economy has held up way better than what the Fed had originally projected when it embarked on this rate tightening campaign about 18 months ago. And so, too, did the market. In fact, the S&P, while down about 0.9% on the day, believe it or not, actually still hovering just slightly above the levels it was at in March of 2022 when the Fed started this rate tightening cycle. So a market that has been through a lot of ups and downs ever since then, but the net effect of is that it's held up and, more importantly, delivered for most investors some modicum of return. The Dow Jones Transportation Average slightly unchanged here on the day. While we did finally see a pullback in the oil markets, we saw a pullback in gold, and we saw a bid come back into the dollar. That's basically the cross-asset story right now, minus what we saw in yields. But let's talk about what we saw in yields today. Of course, there will be a lot of talk about the two-year yield hitting the highest level since 06. But quite frankly, most of the Treasury curve right now has been camped out at some of those levels that we've seen back in 06, 07, and 08. That includes your 10-year, that includes your 5-year here. A cycle right now that has us at these, well, let's just call it a cycle high, a generational high, if you will. But if you believe those economic projections, and if you believe the words that came out of Jay Powell's mouth, these lines will continue to creep higher.
Yeah, I like the way you put that, generational high. Well, the Fed's ongoing draining of its balance sheet has also removed a backstop for a key corner of the funding space, and that is fueling volatility in the market for repos, repurchase agreements. For more, let's bring in Bloomberg's Alex Harris. I think we tend to forget that at the same time, there's still quantitative tightening happening. Why is this important?
Yeah, you know, I wish we would have heard a little bit more about it in the press conference today, because it is important, and especially if you think about it in the context of these basis trades. The whole foundation of a basis trade is you're taking a position in futures, but you're also taking a position in the cash market for treasuries, and those trades that leg gets financed in the repo market. So now if you're trying to finance basis trades and now you're looking for paper and it's not there and you can't go to the Fed and get more of it because they're backstop, they're not holding as many treasuries anymore, this gets really expensive, and it makes for a very, very volatile repo market, more so than we already see just on typical periods.
But why don't you think that Powell is, at least publicly, doesn't seem to be as concerned about it? I mean, he only really mentioned this once on his own, and I think one of the questions that was posed to him on this, he kind of didn't really even answer it.
You know, I think there's just so many wild cards when it comes to the balance sheet in terms of reserves. You know, the key question when everyone talks about the balance sheet and quantitative tightening is this lowest comfortable level of reserves. What's the total number of reserves that banks need to be holding on to before you hit that point of scarcity, before the markets get volatile and we get something similar to a blow up that we saw in 2019. And after March of 2023, after SVB and the other bank and the turmoil in the banking sector, nobody knows. And there was a senior financial officer survey that the Fed released in August. And they were saying that those levels are actually much higher than they were at the beginning of the year. So now the calculus has changed and nobody knows. And it's a big wild card. And I think if you're the Fed, you need to present confidence that this is going well.
But if you're the 19 members here on FOMC, or if you're the staff providing these reports, and you go into that next meeting, October 31st, November 1st, and you have to discuss this issue here, can't you make a case, and I think Powell used this phrase to some degree or another, of normalization? normalization, the idea that while there is some ructions going on in the market, it's kind of just taking us back to what, in his mind, where the market should have already been.
Yeah, yes and no, but again, it's like that risk of going too far, and that's what we saw in 2019, and I think that's what really has people concerned, is when the Fed isn't quite sure of where that lowest comfortable level of reserves is, where that flat part of the demand curve is. That's what gets them scared, because if they don't know, nobody knows, and then you risk running into and creating this volatility and creating this turmoil, and then that causes an abrupt stop to their whole plan. So that means no rate hikes, because how do you communicate that you're stopping the balance sheet unwind while you're still raising interest rates? And communication, let's face it, isn't necessarily the Fed's strong suit in trying to work with these dualities.
Yeah.
All right, Alex Harris, great to see you. I know it's been a busy day for you.
By the way.
You do?
I think it's the best we've had in years.
You think he's doing a good job?
I didn't say good. I just said it's better than what we've had in the past.
He's doing a job. I agree with that. Well, let's ask our next guest that question. We have Andre Skiba. He is RBC Global Asset Management Head of Blue Bay U.S. Fixed Income. And Andre, come into that debate that we just had. When you think about what we heard from Powell and what we've heard from Powell really over the past couple of years, how would you rate his communication job?
Well, hello. Thanks for having me. It's been a difficult message because Fed is essentially telling you it's all going to be okay on multiple fronts, that growth will come back soon close to long-run averages, inflation will moderate, and unemployment will only tick up modestly. And there is a fair dose of awareness within the market that Fed's projections have changed dramatically every 3 months, quite a few times when you're looking at historical summary of economic projections. And what we could be hearing from the Fed 6-9 months down the line could be very different from the very benign message that we're hearing today. So there is a fair amount of questioning. Is it too good to be true in terms of the forecasts?
Yeah, and I think that question was put to Jay Powell as well when people kept pressing on this idea of a soft landing. What surprised me is that I think for the first time, I heard him say that the soft landing or a soft landing is a primary objective for the FOMC, even though we know it's not part of its mandate. Do you get a sense that policymakers are getting ahead of themselves here in talking up the likelihood of a soft landing? New York Fed President John Williams recently said recession talk in the finance sector has basically vanished.
Look, there is some truth and validity to that concern, that how much are you locking yourself into specific outcomes? But at the same time, Chair Powell was careful not to say that that is their base case scenario. So that still opens the door to responding to changing economic conditions over the coming months and quarters. And at the end of the day, after so many hikes and also meaningful tightening of bank lending standards that is filtering through the economy, it would be really surprising to see everything proceeding very smoothly over the quarters to come. So saying that soft landing is not a base case scenario, we think that is appropriate.
Then when you measure up the market reaction today, and we'll see whether this actually carries over beyond just a couple of hours post-meeting here, but we talk about the direction of the yield curve right now, pretty much across the board. We talk about inflation expectations if you go out at least 2 to 5, 10 years, seem relatively grounded here. And of course, you had the big sell-off on the front end of the curve and somewhat sparing the longer end of the curve. What does that tell us?
Well, higher for longer seems to be the theme of the day. Doves did not get any interesting news from the press conference. So the market is adjusting front end of the rates higher, and the expectations for maybe middle of the year cuts next year have been pushed out to maybe July or September. And look, we will see how the data is evolving. It is very clear that the world can look very different 6 months down the line. So we should be open-minded to Fed adjusting communication further down the road. What was interesting, though, is how some of the FOMC members have changed their long-run rate expectations. So there's been this great debate about what is the R star, what is the neutral rate, and is there a need for that to increase? And we have now seen the evidence in the summary of economic projections that the range of estimates has actually, the upper band has moved up. And Chair Powell has also admitted that it's a possibility that it's higher than Fed is currently forecasting. And when we're looking at fixed income universe over the coming quarters, how that debate is unfolding will also have meaningful implications for how risk assets are doing and whether people are taking advantage of the current high yields within fixed income or taking a step back.
Yeah, and it's interesting, too. We should point out a unanimous decision today, and we should point out all the meetings we've had going back to March 2022, all but 2 of them unanimous. Anjay, great to catch up with you. Anjay Skiba there over at RBC Global Asset Management. We're going to continue this conversation, our special Fed Day coverage, continuing with David Balin, Citi Global Wealth Chief Investment Officer and Global Head of Investments. That conversation coming up after the break. This is Bloomberg.
I've always been a person who's just been attracted to hair. I like to sit and think and theorize how I can manifest these visions that I have for braiding and how I can take something that may seem like it's a line drawing in my mind and apply that to someone's scalp.
We are the